A delay to stimulus plans means one thing for markets: this may get worse. Tit for tat, China tells the US to close its consulate in Chengdu. Mike Pompeo dubs the Chinese president a, quote, true believer in a bankrupt totalitarian ideology. Plus, a bubble warning: Intel shares slump after another production delay. This follows big drops in Microsoft and Tesla shares despite solid results. Matt, what do you see in the futures?
We see futures that are down right now. Concerns about the escalation in U.S.-China tensions have prompted a bit of a sell-off here, as well as concerns about the rising jobless claims in the U.S. So drops of 1.5% on DAX futures and Euro Stoxx 50 futures alike. Markets opening up now, and if we pull up the global macro movers screen, you can see in the far left-hand column the equity indexes as they open, starting with the FTSE as usual, down about 1%, and the Spanish IBEX in Madrid also down now a little bit more than 1%. We're going to continue to get the European continental indexes that open up worse than the London FTSE. So Netherlands AEX, for example, to Amsterdam, opens up down 1.5%. The CAC 40 in Paris down 1.2%. European markets just in general opening much lower this morning. That is after those bad economic data points that we got in the U.S. The jobs or the jobless claims number from the U.S. confirmed to some extent what a lot of people
Good morning, everybody. Welcome to SG Trader, the live trading channel. Follow us for free, copy our trades, and make some profit. We trade live our own funds in front of you and our customers, so you can see how we make profit. What we show you today, you see 5 Forex pairs. You'll see Japanese yen, you'll see British pound, we'll show you Canadian dollar, euro, and Bitcoin. Every time we place trade, we place it, we will show you when. We'll place it before the trade will be executed. This is the deal. And after, when it will be executed, you will see on our ticker what we hold, how long we're going to hold, and when we sell our position, you'll see how much profit we make. So welcome and follow our trades.
Paul, let me ask you about savings in the US and what difference that makes to your universe and what difference it makes to the type of stimulus that might be appropriate, because we see savings rates really rocketing in the US and in other parts of the world as people firstly didn't have, for a period, didn't have much to spend the money on, but also are fearful about what the future holds. What does that tell us about the type of stimulus that would be most useful at this point?
Well, I think that means that the stimulus needs to encourage those savings to be spent. And of course, we've seen in some cases a reduction in taxes to encourage consumption, perhaps in forms of VAT cuts, etc., which tries to get some of those forced pent-up savings back out into the system. But that can be only temporary. There's only so many times you can go out and visit that restaurant, etc. But probably the longer-term solution is to see more investment recovery type investment, like recovery fund that we're seeing in Europe, but also perhaps other infrastructure-led stimulus coming through. So to encourage those savings to get out into the real economy and get used and be multiplied over time. So I think that's what we're looking for. Unfortunately, it's going to take a long time. As you say, people are cautious because of the virus, but also cautious about job security. So I think we'll see that savings level come down very slowly over time.
You know, I was watching a Jack Ryan film last night, and the premise of the movie is the Russians try and cause some serious damage to the U.S. economy and short the dollar at the same time. And I thought, hang on a second, that doesn't really work, because whenever there are real problems for the U.S., investors globally flock to the dollar. If we start to see more and more bad data points out of the U.S. economy, Paul, or a continuation of the bad trends for the coronavirus pandemic there, do you expect to see the dollar strengthen again?
Yeah, I think I've seen that movie as well. I think it's interesting this time around, actually. You're seeing a dollar weakness on some of the latest concerns over the last 24 hours or so. And strength of other currencies that are perceived to be perhaps safe havens, Japanese yen, but even the euro now. The euro has been cited perhaps as a currency that could, for the first time in a long time, act as a bit of a safe haven because its own future is a little bit more certain now than it was. I think the dollar weakness trend is there. We'll get bouts of running back to the dollar in periods of uncertainty, but essentially the amount of dollar liquidity that's in the global economy is at a surplus, and therefore the dollar should decline. And once we run into the presidential election, and of course the fighting in that area gets, in terms between the two candidates, between the two sides, gets very significant and perhaps nasty, then I think we'll see people be concerned about the outlook for the US in general, and probably therefore look to put capital somewhere else, yen, Swiss franc, euro, for instance, as an example.
Yeah, Shadow Recruit, I think, the film that Matt may or may not have been watching yesterday. Let me ask you about other places you might go in times of uncertainty then, Paul. What about gold? We've talked a lot about how it's rallied very strongly, and maybe that's giving us a different message to the rally that we're seeing in stocks. What does the rally in gold mean to you?
Well, we on the fixed income side don't use gold as an asset class, but in our multi-asset absolute return strategies we do, and we've got quite a significant weighting there, and happy to hold on to that. See that as fulfilling its purpose as acting as a safe haven. But the other side of that, of course, gold is, when we're looking at gold, we're pricing it against the dollar. And the other side of that is, and I come back to that story, the dollar's in a weak trend. So gold will rise as the dollar weakens. Will it rise faster than some other currencies? I think during a crisis situation, it has tended to do that, and we've seen that already. But I'm not sure it will actually rise more significantly than maybe other currencies or other precious metals. And also be interesting to see how commodity prices react. Of course, they have recovered, and we've seen things like copper, for instance, recover. But I would say they're not actually matching the recovery we've seen in other risk assets. So I think maybe if the economic recovery continues to build globally, I think we'll see the commodity prices in general rise. And of course, they are getting support from the fact that maybe China, maybe some of the Asian countries have greater flexibility to stimulate economic growth than perhaps we're seeing in the US at the moment.
All right, Paul, we're going to keep you with us. We've got more to talk about with you. Paul Brain from Newton Investment Management. He's the head of fixed income there, stays with us. Of course, he has expertise across a lot of other areas, including currencies. Coming up, yield hunters. We're going to talk with Paul about why he still favors the periphery when it comes to European debt, even as spreads touch 5-month lows. This is Bloomberg.
Welcome back to the European market open. 10 minutes into a negative session for European equity markets. US futures also pointing to the downside. And in fact, those losses on US futures worsening. So Nasdaq futures now pointing down by 1.2%. Here in Europe, we trade weaker, down by 1.6% on the Stock 600. Let's get a Bloomberg Business Flash for you now. For that, we stay in London here with Laura Wright.
Thanks, Anna. Equinor has reported a surprise profit in the second quarter. The oil company was boosted by trading gains and a tax change in Norway designed to help the oil industry through the crisis. Equinor also set itself apart from peers by not reducing long-term price forecasts. That means it's avoided huge write-downs. Vodafone says its tower IPO is on track for 2021. Investors were looking to see if the pandemic would derail the plans to list the mobile mast unit in Frankfurt next year. The listing is seen raising more than €2 billion for the company. Services revenue fell for Vodafone. It was hit by travel restrictions which dented international roaming fees. Disney is cancelling the August release of Mulan and delaying future Star Wars and Avatar movies by a year. It's the latest sign of the pandemic's impact on Hollywood and the third time the Mulan remake has been postponed, this time with no new release date. Some cinemas are also having to push back reopening plans. That's your Bloomberg Business Flash. Matt, Anna.
Laura, thanks very much. Laura Wright here in London with the Business Flash. Let's talk about what's going on here in Europe then, shall we? In the recovery fund we saw pass earlier this week. With the passing of the EU's landmark €750 billion recovery fund, the spreads between German bunds and Italian BTPs is at its lowest in 5 months. The biggest beneficiaries of grants from the fund are likely to be Italy and Spain. Italian benchmark yields have fallen below 1% and haven't been this low since February. Paul Brain, Newton Investment Management Head of Fixed Income, is still with us. Paul, I think you like some of the peripheral bond yields or bonds in government bonds in Europe, Spain and Italy, I think. Do you still like them despite the fact we see such compression in the yields? They're still worth it?
Yeah, I think so. I think we were expecting them to get down to levels that we saw at the beginning of the year before the crisis started to undermine the finances at the periphery. So essentially, we're looking for the Italian spread to get down to around about 120, 125. And also beyond that, because of the recovery fund and the way, of course, it's being jointly funded, this is a new era for the euro and a new era for Europe. And essentially, that means that the liabilities are spread amongst all the members and not just in the hands of the periphery. And the support for the periphery in terms of grants and loans is fairly significant. It should help them with their economic recovery. So all in all, I would expect to see spreads get down to the previous lows we saw back in 2015, 2016, around about 90 basis points for Italy. Because essentially what we're looking at is joint risk now. We're not just looking at buying Italian bonds and worrying about the Italian government supporting that. We're looking at that risk being shared. So I think they can continue to narrow. It will take time because there's an awful lot of issuance to be done. There's a lot of Italian debt to work through, Spanish debt to work through. So they're the two that we tend to favour at the moment because they're big enough and liquid enough, and they're the ones that we're long off at the moment.
We've heard already the European Parliament with some issues in terms of the validity of the rescue package agreement, and of course that money's not going to be spent until 2021, some of it 2022. Are there any concerns for you that this rescue package somehow gets off track?
Well, I think once they've made put in place the precedent, if you like, of getting together and supporting each other, which is something that's always held back the euro in our minds, and also is a reason why you do get those spreads. I think we'll see a realization that without it, the economies are not going to recover, and the cost of debt will be too high. And the other point is, in the interim, and certainly over the next couple of years, the ECB are there supporting the markets with their PEPP program, their pandemic program, and that will be driving spreads lower as well. So I'm not too concerned that the deal gets thrown out. I've seen many times, and we all have, that Europe tends to spend its time coming to ultimate conclusions, but essentially we do believe it will get through and will support the European economy eventually.
Let me ask you about some data that's just breaking across the Bloomberg right now, Paul, and this is to do with manufacturing PMI and services PMI in France, and we're going to get more of this from various parts of the world through the day. And the big point here is we're firmly back above 50 on both fronts, in particular services. So manufacturing now at 52. The forecast there was 53, so perhaps a little disappointment there. But services PMI at 57.8. The forecast was 52.4. I mean, lots of people argue about how meaningful these types of statistics are at this point, given what we've seen for the global economy. And interesting to see the euro isn't gaining much more ground on that, but it is still just above 116. Does any of this data on the speed of recovery in Europe, does it threaten to change your strategy at all?
No, I don't think so. I think without the low interest rate structure, and without, as we spoke about, a shrinking spread across the European bond markets, this recovery is not going to be maintained. And of course, the PMIs, as we know, in this sort of environment, they're a bit of an on-off switch. Obviously, the economies have fallen so much to recover from a very low base. You're going to get numbers north of 50, suggesting there's an expansion. And it's very difficult, really, to work out whether a 57 or a 67 number that could happen is actually that meaningful. The fact that the economy is recovering is obviously good news. So, no, I don't think it changes our outlook. The Euro's had a very good week this week. It's been very strong all through the week. So I would expect to see some profit taking and some consolidation, and especially as it's Friday. So, yeah, I'm not too worried if the Euro was to drop back a bit over the next 24 hours or so.
All right, Paul, thanks very much for joining us today. Paul Brain is Newton Investment Management's head of fixed income. He's going to be continuing the conversation with us on Bloomberg Radio at 9 a.m. UK time, and I'm glad because I have more questions. I was thinking as I took a shower last night about tips, so I wonder what Paul has to say about inflation-linked securities. Coming up, suing Google for pay disparity. 4 former employees are trying to bring a class action suit and get it approved. More on that next. This is Bloomberg.
When we went into this quarter, we knew that it was going to be very challenging.
The mantra was, if it costs money, the answer is no.
The situation out there is still very challenging and very difficult to predict. So we should never be complacent.
We'll have to watch carefully to see if there's a true significant second wave in the second half.
As we look forward, we think that the results in the second half year will improve.
We actually don't have the courage to give a real firm guidance for the second half.
There's going to be stimulus in the market. There's going to be political uncertainty. So I think there are a few ingredients in the second half year that can truly drive volatility.
Some interesting voices there, some of the CEOs and business leaders we've been speaking to during earnings season so far. Of course, earnings season continues in the next couple of weeks as well. Let's take a look at some of the movers and some of these stocks responding to the earnings story. One of those is Signify, the lighting business. Second quarter numbers beating estimates. The CEO saying the company is ready for recovery. That stock up by just over 3% right now. Centrica, this is a UK listed energy business. They're selling their US energy unit, and as a result of that, we see the stock is up by 21.5%. So some real appreciation for the story there. Infineon also in focus. In fact, it's the broader chips space that is in focus here in Europe. After we heard from Intel yesterday, Intel warning about another production delay. As a result, we see Infineon moving down by 4.8%, ST Micro down by 4.6%. So we see broad-based selling across the chip space, across tech. And with that in mind, interesting to see that NASDAQ futures are down by 1.4%, Matt, underperforming what we see on other major US markets right now.
I want to bring up some breaking news on treasuries, or on pricing at least of treasuries. 5-year treasury yields, and as you have seen, have fallen now to a record low of just over 25 basis points. So if you take a look at the 5-year here, you can see we hit it was actually 0.2548. I'll follow Tom Keene's example and go out 5 significant digits, which I think is what fixed income traders prefer. So 0.2548%. Is it 4 sig figs? Because you don't count the 0 point? I see. Okay. My producer here correcting me. He's much closer to high school math than I am at 46. In any case, you can see this drop, and it's just another example of the incredible shrinking yields. I mean, Anna, we had a story the other day on Bloomberg News about a huge amount of treasuries, a huge amount of sovereign debt being issued. Eventually is going to overwhelm central bank buying, and then you're going to see yields rise. And I just hope this happens before I have to start buying these bonds for my daughter, because, you know, at 25 basis points, she's not going to make much.
Well, that's true, and if it depends on the investment horizon you have in mind. But yeah, interesting story, and it is really interesting to see as we get headlines from the UK, from the US about all the issuance that is taking place, the amount of borrowing that is happening, and yet these yields remain as low as they are, and in many cases continue to fall. When will that catch up with us, I wonder? Turning to the business of equality now then, Matt, and 4 former employees of Google are trying to get a court to pass a class action lawsuit. It would allow the 4 women to represent more than 10,000 peers in a gender pay disparity suit against the tech company. For more on this, we're joined by Bloomberg Quick Takes Jennifer Sabasaja. Jen, good to speak to you. What's the latest then on this Google story?
Yeah, so Anna, you know, class action statuses for gender pay discrimination lawsuits don't have the best track record within the tech industry, but these 4 former Google female employees are really hoping to step up the pressure on the industry and move the needle forward. So if they are granted class action status by a judge, as you mentioned, this would enable them to represent over 10,000 of their colleagues. According to the lawsuit, they say that Google paid women less base salary, smaller bonuses, and even fewer stock options than men in the same job code and locations. And they claim this behavior spanned across all different positions within the company and violated California's Equal Pay Act. Now, it's important to note this is not a new case. It actually dates back to 2017. Google, for its part, has tried to dismiss it in the past. In 2018, they tried doing that. And a Google official defended the company's policies and actually called these claims unfounded. But, you know, with the current climate, I imagine a lot of eyes will be on which way the judge sides. Earlier this year, a group of women suing Oracle over unequal pay marked a huge milestone for women in the industry when they won class status. But, you know, similar cases against Twitter and Microsoft were denied. So, you know, this class certification hearing isn't until December, but if granted, an economist at UC Irvine estimates these women could seek somewhere near $600 million in damages. Anna?
All right, Jennifer, thanks. I'm going to pick it up here. Jennifer Zabataja, they're our Bloomberg Quick Take reporter. Don't miss our Quick Take show at 6 p.m. UK time tonight on Facebook and 6 p.m. UK time on Sunday, July 26th on YouTube. This is Bloomberg. Welcome back to the European Open. We are 30 minutes into the trading day right now, and we're looking at losses across European equities. In fact, let's take a look at the benchmark Stock 600 index right now and see how it's doing in the first 30 minutes of trade. You can see it's come down and is now off almost, 1.7%. I was going to say almost 2, but it's not quite there. If you take a look at the GRR screen, which is your group ranked returns on this index, you can see which groups are falling the most. Tech is the biggest loser after the Intel drops. Really, Intel, Microsoft, Tesla yesterday in the U.S., leading to big tech drops here in Europe today as well. You've also got healthcare and basic resources as big losers. In fact, all of the groups are falling, oil and gas and utilities falling the least. Let's get the Bloomberg first word. You know what? Let me give you the German PMIs first, because we're getting July services PMI rising 56 to 56.7, and the forecast was only for 50.5. So the German services PMI in July blowing the estimates out of the water. In terms of manufacturing, it's also a beat, though not quite as far into expansion territory. The manufacturing PMI in July was a solid 50, an even 50, and the forecast was for 48. So those are the PMIs, which you're going to want to watch very closely. Now let's get over to Laura Wright. She's got your first word news. Laura?
Thanks, Matt. The U.S. economic recovery looks to be stalling. Initial jobless claims rose for the first time since March to above 1.4 million, but continuing claims did drop slightly. The data comes as hundreds of billions of dollars of federal aid is set to expire. It adds to fears the U.S. economy could be at risk of a double-dip recession. The UK has announced its biggest ever flu vaccination programme for the winter. That's as it seeks to protect the NHS from a possible second wave of coronavirus. Officials hope to vaccinate more than 30 million people. That's almost twice as many as last flu season. Free jabs usually available for the over 65s and at-risk groups will be available to everyone over the age of 50. Disney is cancelling the August release of Mulan and delaying future Star Wars and Avatar movies by a year. It's the latest sign of the pandemic's impact on Hollywood and the third time the Mulan remake has been postponed, this time with no new release date. Some cinemas are also having to push back reopening plans. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna, Matt.
Okay, ladies and gentlemen, I just placed an order and sold euro at 116.027. So position open, short position at 106.027.
That's right, Anna. Well, we found that during the pandemic and the recovery period, urban space is really at a premium. So pedestrians need more space on pavements to stay socially distanced. Places serving drinks and food need to move outside because the interior spaces aren't safe. And bikes, which are pretty much the safest way of traveling long distance at the moment, they need safer space on the road. So there's really a kind of fight for those competing demands for urban space. And so far, we found that it's space that's previously been allotted to cars that has ceded grounds to those other uses. So protected bike lanes have been carved out in many cities to make getting around easier. They've had 650K of them rolled out in Paris, for example. And bars and restaurants are moving outdoors, not just onto pavements, but actually onto the roadway itself, taking over entire streets, something we've seen in many, many places.
Yeah, I saw a lot of streets closed. I was in Spain last week, a lot of streets closed so that restaurants and bars could move their tables further out into the space. And here in Berlin, I know a lot of lanes that we used to be able to drive cars in have been shut down for bikes, which also means that not only can you not drive in those lanes, but you can't park on the side of the road. And as a result, really increased traffic to the point where I feel like the mask is definitely an advantage to my health. How else do we see travel changing in cities, Fergal?
Well, you've already seen those. You've already seen those changes yourself. Certainly, we cannot at the moment get round cities in the way that we used to. We can't possibly safely return to the kind of volumes of people moving around cities in the way that we were. That's meant so far, that's meant prioritizing things like walking and cycling over cars and over public transport. But there are some problems with that. We found in London, for example, that car traffic has actually gone back to about 80% of what it was before the pandemic. So it's more or less recovering, but public transport use is still at 30%. So either people don't need it because they're not going to work, they're still working from home, or they're still afraid of contagion risk caused by close contact. So right now, we're in a position where we're probably, most people are going to still need to stay working from home for the near future because we don't yet have the means of going safely back to work while maintaining social distancing.
Yeah, I have to say that is the major reason why I'm sitting here today and not in a more central London location. Fergus, the Paris mayor has been talking about the 15-minute city, and this was something that was talked about before COVID and has attracted, it seems, increasing amounts of attention. Is this a theme that many cities around the world are picking up on?
Absolutely, absolutely. Paris has gone further than anyone, and they've just appointed a commissioner specifically for the 15-minute city. So they have an officer looking after that concept. And that concept, what it refers to is the idea of a hyper-local, neighborhood-focused type of city planning in which almost all of a citizen's needs can be met within 15 minutes travel of their home. So that means work, leisure, schools, hospitals, arts venues, everything locally accessible. That doesn't just make life easier, it means less traveling around the city, which frees up space a lot of the cars, so you can use it for other reasons, other uses, and it cuts pollution. Now, the reason why that's particularly booming at the moment, because it's not just because that's seen as more sustainable, it's a type of way of organizing urban space that is far more resilient to pandemics and to lockdown conditions. And it means, if we're living like that anyway, it means far less disruption to our lives if we need to keep within the local area. So that's very much a buzzword that's being discussed in London, both in the boroughs and on the citywide level. And it's very much come out of this urbanist niche space, and it's being talked about widely across the world now.
All right, Fergus, thanks very much. Fergus O'Sullivan is a contributor for Bloomberg City Lab. Great to get some insight from you on, I think, something that interests everyone watching the program and something that we're going to continue to talk about. So we'll have Fergus back as soon as we can. I want to check out some of the risk assets that we see putting up some big moves today or getting near records. Gold, for example, close to the big round number of $1,900 a troy ounce, right now at $1894.91. There you can see silver as well at $22.67. I'll go out 22.6763, which is 6 significant figures there. Up next, a card made out of corn. The fintech startup GoHenry is offering biodegradable bank cards to young people. We'll talk more about the future of a cashless society and Generation Z with the company founder Louise Hill. This is Bloomberg.
Welcome back to the European Market Open. 41 minutes into a trading session that is weak for European equity markets. We're now down by 1.9%. A host of factors taking us lower. US futures also weaker. We've been looking at heavy selling in the Chinese market overnight. Chinese-US tensions part of the story. Weak US data also a key part, and the earnings season as well, and the numbers we got from Intel weighing on tech stocks here and on Nasdaq futures. Now, the coronavirus pandemic has increased the need for cashless payments, and startup company GoHenry is hoping to empower young people to take part in the digital economy. GoHenry offers a prepaid Visa debit card and app with unique parental controls designed exclusively for 6 to 18-year-olds. The goal is to help young people learn good financial habits in an increasingly cashless society. The fintech startup also launched the first ever eco card. It is biodegradable and made out of corn, apparently. Let us speak now to Louise Hill, the founder then of GoHenry. Louise, really good to speak to you. So I was reading with interest, journalistic and personal interest about your business. And I wanted to ask you, though, about what's to stop banks doing what you're doing? I mean, if they've got the customer base already, what's to stop them doing it, and then parents maybe don't feel the need for another product?
You know, when we first launched 8 years ago, that was something that really concerned me a lot. I thought one of the big high street banks would simply come in and copy us. But what I've realized over the years, this is an area that's our absolute core focus. And for the big banks, it's kind of an add-on. And their legacy systems, their infrastructure means that they're not able to be as nimble and as quick as we are as a startup. And also, as I said, it's not their prime business. So we're able, we launched a product that was aimed at parents with kids in this space, and we're able to design something that's perfectly targeted to that.
So I imagine this gives you a valuable snapshot of what these kids are buying. I saw a little bit of Fortnite there in the intro video. I will admit, when I started playing, I thought the skins would give me some kind of added advantage over competition, and I dropped 99 quid on a pack of skins. Is this what kids are buying? Are they paying money for video game purchases?
It's amazing to see where the money is being spent, actually. We released last year, in October, we released a youth economy report, which was the biggest report ever of its kind, looking at actual spend, not survey data, but actual spend and where children are spending their money. And it's really interesting to see. Pre-COVID, and I have to say that, you'll understand why in a moment, teenage girls are absolutely propping up the high street. They are using money as a social tool to go out and about. And maybe predictably, teenage boys, one of the stats that amazed me was that 12 to 13-year-old boys are spending an average of £200 a year on gaming, exactly as you said.
Right, teenage boys and Matt. We're getting a lot of insight into Matt's viewing and gaming habits, Louise, today. But thanks for giving us the insight into what children are spending their money on today. Let me ask you about the monthly fee. So the way your business works, you charge a monthly fee, and I find that interesting because you're sort of educating a new generation of bank customers into the idea that they will pay for banking. And most people in the UK, I imagine, don't pay for banking services, at least not with an upfront charge, an upfront fee. They might pay charges, but that's different. Did you think about other ways of funding this model?
We did. The simple fact is that every single movement of money we have to pay for, and so do the big banks. The big banks, their business model in the UK is more around making their money from mortgages and credit and that kind of thing. Obviously, that's not open to us with a market of under 18s, so we need to charge a fee. We make that fee as low as we possibly can, and we make it as simple as we possibly can. There is just a monthly fee per child, per account.
Where are you looking to grow, Louise? Because I know that, some countries, like here in Germany, still value cash, whereas in Scandinavia, there's so many places where you can only use, digital. So what do you see as far as growth plans are concerned?
Well, for the moment, we operate in the UK and the US. We launched in the US almost 2 years ago. And a couple of months ago, we hit 1 million active customers between those two markets. We still have a huge amount of growing to do in the US, but yes, eventually we would like to roll out wider than that. And actually, as you say, it's interesting when you start looking around the world, the concept of teaching your children about money is worldwide. And the only limiters for us are access to the internet, access to digital online spending, and that is incredibly widespread. There are variances between countries, as you say, between Germany and Scandinavia, for example, but the market is huge.
Louise, clearly your business benefits if people want to move towards a digital society. But that said, how much quicker do you think we will move towards I don't know, fully digital, if that's possible, society, given COVID-19? How much has that sped up that process?
I think hugely. We already knew that our customers, the GoHenry children and teenagers, they obviously have access to digital spending and a card. They very seldom choose to use cash. So only 14% of the 109 million pounds last year spent by GoHenry customers, only 14% was actually taken out as cash. The rest was all spent using a card or contactless or online. With COVID, that's increased. So that has really accelerated, and obviously contactless has become even more mainstream. And we've often talked about our customers and Generation Z as being digital natives because they've grown up with online being part of their lives, learning through the internet and computers, etc. But they really are cashless natives as well, and probably the first generation of cashless natives.
Louise, thanks very much. Thanks for sharing the story with us. Louise Hill, founder of GoHenry. Coming up on the program, gold is closing in on its all-time high. I can see the gold price now, 1895 and a bit of change. So not all that far from the 1900 mark. There's concern really about global growth, and that's continuing to boost the precious metal. We'll discuss that next. This is Bloomberg.
Welcome back to Bloomberg Markets. This is the European Open. 50 minutes into the session, 52 minutes into the session right now. We're looking at drops of 2% in Frankfurt and Paris, 1 2/3% in London. Gold is trading near $1,900 an ounce, edging closer to its all-time high set almost 9 years ago. Mobius Capital Partners co-founder and partner Mark Mobius says gold is an attractive asset to hold right now. He spoke with Bloomberg on emerging markets and the precious metal.
Oh, yes, I would be buying now and continue to buy because gold is really
silver?
on a run, I think, doing well.
What about silver?
Silver also, because silver, of course, will follow gold. But gold is, of course, the most important.
Joining us now is Bloomberg's Markets Live editor, Eddie Vanderwald. And Eddie, it's understandable that Mobius would advise investors to buy and continue to buy gold as long as he's holding it, right? But to a lot of people, it just doesn't really make sense. There's no return. You can't directly buy things, transact with it. I think, was it your line that it might be just a pet rock of sorts?
Right. I think that is a slight that we hear in the gold market quite a lot. And it is true, gold pays, yields, but nothing else does at the moment either, right? And, as far as fundamentals go, pretty much everything is disconnected from fundamentals at the moment. I think what gold is telling us right now is more that there is a lack of faith in policymakers, and gold is that kind of referendum on, how well the market perceives central banks are doing. And I think there's just enough people out there that are worried about ultra-loose monetary policy that they want to buy something that is a hard asset that offers them inflation protection, for a fairly low cost.
That's interesting. It was actually our colleague Mark Gilbert who wrote a story saying that gold bugs say that this offers the great protection from central banks, but that if you don't like gold, then you suggest it's just a pet rock, which I think is just a brilliant line. So do you really think then that to what extent then does this rise in gold suggest we've lost faith in what central bankers can do here, Eddie? Because we see yields on government debt continue to move downwards, and I wonder how that plays in.
Yeah, I think it's a very important factor. I read Mark's piece, and it was a really strong piece this morning. There's been a lot of commentary on gold, and I think that is the key here. I think partially what got this rally started is the lack of faith in central banks. But I think from here on out, what happens is people start talking about it, right? As you approach the record highs, people start talking about it. You see more column inches about it. You see excitement building around the gold price. And gold is a mania-prone metal. As you talk about it more, you draw in more retail investors, and that pushes the price up. That makes the test at the record high significantly likely, and further gains beyond that.
What do you think about the rally that we've seen in silver? As Mobius put it, it follows gold. How do you see the relationship changing, though?
Right. The favorite quote that I've heard on silver is that it echoes and amplifies gold. It does move alongside gold, but it does whatever gold does more so. I think the beta is 1.4 or something. And if gold goes up, and silver is a much smaller market. If you see large hedge funds pushing in that way, it can move very quickly. I was looking at the data yesterday. Back in 2011, silver went from $26 or so to $50 in the space of 3 months. It's a metal that can move very quickly, but it can also come down very quickly. So you've got to be a fairly fast mover if you want to get in on that rally.
Eddie, thanks so much for joining us. Bloomberg Markets Live editor Eddie Vanderwald joining us there with the latest on gold and silver. And Matt, we have a sell-off underway, it seems, in global stocks. It started in Asia, through to Europe now, down by 2%. US futures also pointing lower. And there does seem to be increasing concern about tech, doesn't there, Matt? We see the NASDAQ futures down 1.3%, and those Intel numbers getting some attention here in Europe as well.
Yeah, NASDAQ futures dropping about twice as much as we see S&P futures falling right now. So it does seem that tech is the biggest losing group in Europe as well in the cash trade. I'm sure they'll talk more about it on surveillance. We'll talk about it on radio.
Tit for tat, China tells the U.S. to close its consulate in Chengdu. Mike Pompeo ups the rhetoric against China, calling President Xi a believer in a bankrupt totalitarian ideology. In the U.S., a Republican plan for pandemic aid won't be rolled out until Monday. Meanwhile, UK Chancellor Sunak directs extra relief funding to Scotland, Northern Ireland and Wales. And Intel shares slump amid production delay warnings. The Nasdaq erases its gain for the week on concerns big tech is in a big bubble. Good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, the markets are focusing on a couple of the data that are coming out of the U.S. Of course, they're focusing also on stimulus in the U.S. I am getting data for the euro area. This is for July manufacturing. PMI is 51.1 instead of the 50 that was forecast, so it does seem a little bit better than expected. And then the other thing we're really watching out for is gold. That's 1,897 within a whisker of 1,900. Which will be a big psychological impact. But you can see European stocks are down some 2%. Now let's get straight to the Bloomberg. First word news here in London is Laura Wright. Hi, Laura.
Hi, Francine. The US economic recovery looks to be stalling. Initial jobless claims rose for the first time since March to above 1.4 million, but continuing claims did drop slightly. The data comes as hundreds of billions of dollars of federal aid is set to expire. It adds to fears the US economy could be at risk of a double-dip recession. The UK has announced its biggest ever flu vaccination program for the winter. That's as it seeks to protect the National Health Service from a possible second wave of coronavirus. Officials hope to vaccinate more than 30 million people. That's almost twice as many as last flu season. Free shots usually available for the over 65s and at-risk groups will be available to everyone over the age of 50. Disney is cancelling the August release of Mulan and delaying future Star Wars and Avatar movies by a year. It's the latest sign of the pandemic's impact on Hollywood and the third time the Mulan remake has been postponed, this time with no new release date. Some cinemas are also having to push back reopening plans. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Laura, thank you so much. Now, China demands the U.S. close its Chengdu consulate. The statement by the Chinese Foreign Ministry comes after the American government forced China to leave its mission in Houston earlier this week. Now, the Chengdu consulate opened in 1985 and covers the country's southwest. It acts as a key U.S. listening post for developments in Tibet. Well, joining us now for more from Chengdu is our Beijing bureau chief, Sharon Chen. Sharon, what exactly has been the reaction on the ground? Does this feel like, it's escalated, but it's not closing the Hong Kong consulate, so the U.S. can live with it?
Yeah, I mean, it wouldn't have been as extreme as closing the Hong Kong consulate or even the Guangzhou consulate, which is much bigger in terms of processing visas. But, here in Chengdu, the reaction was immediate. Security on the street outside the consulate was extremely high immediately after the announcement. Police uniforms and soldiers patrolled the street. There were some tourists that all, hoping to look at what's happening.
Yeah, Sharon, we were having trouble actually connecting with you and hearing you 100%, so we'll try and call you back to make sure that the line is correct so that we hear everything you have to say also about this flaring up of tensions between the U.S. and China. To talk now about the markets, and maybe we can start off with the China tensions, let's get straight to James Athey. He's investment director at Aberdeen Standard Investments. James, we were just talking about the escalating tensions between the U.S. and China. What does that mean for your global allocation? How much worse will it get, and what impact will it have on the economy?
Yeah, good morning, Francine. It's obviously a tough one because we've seen tensions as part of the market environment for a number of years now, really, not throughout, but throughout much of President Trump's time in office. It's certainly been part of the fabric of the macroeconomic analysis and financial markets. Obviously, we've seen some escalation in very recent times, but still without really actions which you'd necessarily expect to see a direct and immediate impact on global growth or on growth of the two regions concerned. But I do think it just falls into this big picture narrative, which is to say there are secular forces acting here. We've probably seen the peak of globalization. It's become a bit of a cliche, but I'm going to use it anyway. I think we have seen that there are some costs to such a fully global model, and so countries and companies are going to look to firm up their relationship with each other such that there is more domestic or corporate robustness within their model. And I think this tension between these two powers is sort of part of that process. What it means in the near term, very difficult to say. It hasn't really impacted risk assets until yesterday, and then potentially in conjunction with the weak claims number, we've just seen a bit of a wobble in equity markets from what were incredible valuations, really. So we shouldn't be too surprised. But I don't think it's something that me personally is going to impact my allocation much, because broadly speaking, I'm invested in a way which is cautious with respect to the outlook, because I see this as one of a number of major problems, cyclical and structural, which we're going to have to deal with in coming months.
James, where do you see the most value right now, given all the dynamics of the stimulus in Europe, in the U.S., and everything that we're seeing in between with these tensions?
Wow, I mean, value truly it's almost impossible to find anything that I think you could even remotely call value. There are some assets which have reached the pre-COVID levels and even surpassed those. There are some which have recovered a lot from the nadir of kind of March, April time. But truly to see value, I really do struggle. I think it's incredibly difficult to find assets which show a lot of value. I do think precious metals have a long way to go, because I just think the only way that you can see risk asset performance of the like that we have seen is with this just, central bank and government largesse hand in hand, and that must be, even if it doesn't show up in consumer prices, that will be a debasement of the purchasing power of global fiat currency. And so precious metals to me look like they can push on a lot higher, but obviously where they are today is very close to decade highs. So it's tough to say that that's truly a value proposition as we sit here today. I still prefer to be invested defensively. I think the dollar has some value because it's done a lot to unwind the rally that we saw in the real heat of the risk-off period, and I truly don't believe that there are attractive alternatives to the US dollar. It's shown that it can perform at both ends of the dollar smile. If the economy is doing well globally, the US must be a part of that. It sucks in capital, it pressures interest rates up normally, and conversely, if the economy is not doing well, then the export-driven current account surplus economies with some real structural weaknesses that are out there, they tend to do a lot worse. So I still like the dollar.
So James, let me jump in and actually ask you about gold. Are we going to have 1,900 today, and what happens after that? Does it just go ever higher?
Yeah, I mean, you rightly point out that the way these things work, we are talking about psychology and collective psychology. So the way these things work is that you do find that there are lines in the sand for whatever reason, this one being the previous peak from back in 2011, I think. And it's likely that if there is going to be some selling, that's the sort of level where the selling would come out. But I don't really expect it to be as much of a resistance as maybe others do. And honestly, I mean, it's difficult to put a number around this, but just given the growth of central bank balance sheets, given the growth of fiscal deficits that we're seeing, particularly in the US, obviously, but absolutely everywhere else as well, I just think that the number could be so significantly higher, 50% or 100% higher than $2,000. I don't think is an unreasonable proposition over the next few years.
All right, James, thanks so much. James Athey there from Aberdeen Standard Investments. Now, coming up, jobless claims rise for the first time since March. We took a look at the labor market in the U.S. next. This is Bloomberg.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, there's a lot going on in the markets, or most of them are actually trading sideways. We saw that with a couple of well-known strategists also saying that they were range-bound. Today, stocks are actually dropping because of worries about the U.S. and China. Now, they were worried about it on Tuesday, and then actually they were worried about it on Wednesday. And then yesterday, the markets ignored the Sino-American tensions to focus on better-than-expected earnings, and today they're back to worrying what this means for global trade and the world economy. Now, tech stocks weighing also on European stocks. This is after Intel's warning on a production delay. And then if you look at the offshore one, it's dipping. Gold trading near 1,900 an ounce. That's close to an all-time high. U.S. jobless claims unexpectedly rose last week for the first time since March. This may be the clearest sign yet of a pause in the country's economic recovery as coronavirus cases surge and force businesses to close their doors once again. Initial jobless claims rose to 1.4 million from 1.3 million when the consensus was for no change. Meanwhile, the rollout of any further stimulus efforts has stalled because of lingering differences amongst Senate Republicans and the White House. Majority Leader Mitch McConnell said the $1 trillion GOP plan won't be ready until Monday, and lawmakers had expected McConnell to begin releasing a series of bills as soon as Thursday. Well, still with us, James Athey from Aberdeen Standard Investments. James, I keep on hearing that actually Europe, because of the EU Recovery Fund, is now more attractive than the U.S., but the U.S. economy was at a different cycle before COVID hit. So what's your take?
Yeah, that's one that does the rounds, or has been doing the rounds periodically for a few years now. Again, it's largely born out of valuation, and I have some sympathy with that argument. If you strip out a small number of incredibly large, incredibly impactful, incredibly overvalued or highly valued stocks from the US indices, then the valuation spread doesn't look quite so egregious. But including some of those names, it does look like US stocks are incredibly overvalued relative to the rest of the world, really, and Europe is part of that. Therefore, I understand why people might look to position for a narrowing of that gap. Obviously, there are some composition effects, and it goes back to tech. You've got a value versus growth proposition there. If you invest in the US index, really you're investing in growth stocks. Really, you're investing in a small number of tech stocks. If you invest in Europe, you're investing in the value proposition, which has been on a secular decline in relative sense. I think mean reversion is a realistic impact on markets over the long term. I think there is possibly, therefore, some long-term narrowing of that spread. But I don't think it's a bullish narrowing. I don't think Europe can outperform because I just think the structural impediments to European growth are huge, and I do not see the recovery fund as dealing in any way with any of those structural impediments.
Do treasuries move on the stimulus depending on what they agree on at the end, James, or do they just move on what the Fed does?
Yeah, I mean, treasuries, nominal treasuries, there was a week in June where they spiked higher. Apart from that, they've exhibited zero vol. I don't particularly think that this stimulus package being passed would be impactful on treasury yields. We're living in the world of financial repression. The Fed is there actively on a day-by-day basis and is expected to be there with increasing ferocity if they see a need, and spiking treasury yields would be that. So I think within a small range you could see yields spiking a little bit higher, because it should be good for growth, it should be good for inflation, it should be more treasury supply, but I don't think those are the biggest influences. I think ultimately you're back into this world where the bond market sees lots of bumps in the road and sees a Fed that's going to cap any volatility, and therefore really it's a somewhat asymmetric proposition. And if you own an equity portfolio or a risk-facing portfolio, you don't give up much in terms of negative treasury performance when risk assets do well. So it's a kind of free hedge, and I think that will continue to be the case.
What's your take on earnings so far?
Yeah, which one's gap earnings or the earnings that get kind of hit the headlines and always beat the analysts' expectations, because there is a massive gap between the two. There has been a massive gap for a number of years now. There are lots of things that CFOs can do which don't necessarily pass international accounting standards, which make those earnings figures beat on a quarter-by-quarter basis, and we are seeing some element of that. I think there are some interesting messages that we can see from within the earnings season. I think one of the most interesting was when financials were reporting a bit earlier in this season, where you saw that those with Main Street lending programs, i.e. those that were really lending into the real economy rather than just being sort of securities houses that are mainly advisory and financial market driven, they had massive write-offs. They were looking into the future and expecting a lot of losses from their lending to the real economy. Those financial firms, which mainly take their revenues from financial markets and advisory services and Wall Street, if you like, they did relatively better. And I think that, again, is a message about the disconnect between what's going on in financial markets and what's going on in the real economy. Aside from that, I don't generally take much from these earnings seasons because it's a bit of a game, obviously, with pushing analysts' expectations down just so that you can.
But you do have worries about cash flow.
Oh, massively. I mean, absolutely. There are some companies that, as the economies have reopened, cash flow has quickly come back because they are, sellers of things which we need to buy that are not discretionary purchases. A lot of the cash flow worries, I think, will not show up in this sort of financial market reporting season because they're cash flow worries at the very lower end of the spectrum. Small and medium enterprises, mom and pop, local service providers, those sorts of things. And what you really, I suppose you have to look as a proxy for that to the kind of forbearance world, the lack of rent being paid, the lack of mortgages being paid. And we are storing up huge problems here in terms of that lack of flow of revenue through the economy. And who picks up the bill at the end of it all is very difficult to say. But I think we've seen the best of the V side of the recovery. I think things are going to level off a little now. And depending on what central banks do, depending on what governments do, we are going to see those problems, I think, starting to show their head, because obviously there has been huge damage done, and the starting point was not a healthy one. Balance sheets in aggregate and on average were not healthy at all.
But James, when you talk about storing problems, is there something that could actually turn systemic, that is really worrying once the stimulus from the government ends, both in the US and the UK?
Yeah, sure. I mean, I think it's already been systemic. I think, again, what we see is a self-fulfilling cycle whereby low productivity and low growth is dealt with purely and simply by monetary policy, and that means over-indebting economies, and that over-indebtedness drags productivity and growth lower, and essentially that has fed off itself. And the only reason we've been able to really keep that process going for so long, which is 20 or 30 years, is because interest rates have been falling throughout that period. Now we get to the point where it's very difficult to see interest rates falling much further, and therefore really the multiplier of debt has fallen so far that the amount of debt we need to add in order to get growth back to where it was just becomes absolutely gargantuan, and we're kind of seeing that. I still see the virus as a trigger more than a cause in and of itself. So I do think we are facing and have been facing structural issues. They've just been somewhat masked, if you like, by policy choices.
Thank you so much, James Athey, their investment director at Aberdeen Standard Investments. Now, coming up, as cities emerge from coronavirus lockdowns, the way people use public spaces is also changing. We discuss how with the Bloomberg City Lab team. This is Bloomberg. Hi, Ferguson. Thank you so much for joining us.
Hi, great to be here. It's Fergus without the on.
Ferguson, do you have a massive echo?
Do I have a massive echo?
Yeah, do you hear me an echo? Or you can hear me well?
I hear you fine. I hear you pretty good.
Okay, thanks, Fergus. Yeah, guys, I have an echo. So Fergus, we'll be with you really shortly.
No problem.
In like 1 minute. Are you working from home?
Yes.
Is that nice?
Yeah, it's not bad. I mean, I'm used to it. I've been doing it for quite a few years now, actually, before I came to Bloomberg. Can I just ask, how many minutes is this going to be? It helps me to pace myself in terms of what I deliver when. It's going to be 3 or less.
So it'll probably, it's about 2.5, Sarah? Yeah, so it's about 2.5, Fergus. So if you keep your answers fairly brief, so that we can get through all the questions.
Sure.
This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, as cities emerge from coronavirus lockdowns, the way people use public space is changing. Well, CityLab at Bloomberg has been giving this some thought, and Fergus O'Sullivan covers European cities at CityLab. Fergus, thank you so much for joining us. Now, you've been looking at how authorities and residents have been reclaiming the open space of cities. How difficult is it to replan some of these bigger cities?
Well, I mean, there's certainly an intense demand for it. I mean, urban space is really at a premium at the moment because with social distancing measures, pedestrians need more space, businesses need to come out of interior spaces, and just for people to get around safely. Currently, the best way to do that is with bikes. So those bikes need extra space on the road that's protected. So certainly there is an intense pressure on urban space at the moment. So far, with a lot of traffic being less, it has been space previously allotted to cars that has taken the brunt of that has been used to absorb into other uses. So at our current levels, it's definitely manageable. It's a question of what will happen if or when we return to normal functioning of cities.
So when that happens, I mean, do we need to actually change the way that things are planned effectively? A lot of the ways that we're traveling is changing now, but how do cities get rethought?
Well, the important point to make here is that we really are quite a long way off that. Now, we don't really have the capacity yet without a vaccine for life to return to normal. I mean, currently in London, while car transport has returned to about 80% of its pre-pandemic level, public transport use is only at 30%. Now, a lot of people feel that it's not safer to travel in higher volumes than that. though the evidence doesn't necessarily confirm that fear. But so even with the uptick in cycling, there's going to be very difficult to absorb the same number of people that were traveling in rush hour during our rush hours in our busiest cities. So I think for now, it's important to recognize that people who can are going to stay working from home for quite a long time. As we start to emerge from that, there are going to be strong pressures from cities to retain a lot of the features that they've introduced during lockdowns, like wider pavements, more bike lanes.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
We feel like the principles we use to guide our work, the policies that we are really transparent about and then enforce consistently, the way that we show up in our conversations with advertisers, with content partners, with agencies, and with human rights groups who have an important voice around these things, have really helped us differentiate ourselves and just stand on our own, where whether it's around the conversation that's happened over the last few weeks or other conversations, they understand how we think about things, and they we learn a lot from the engagement that we have with them.
But clearly, we're not coming out of the pandemic anytime soon. Obviously, the economy is suffering. How much longer do you expect there to be a retraction in global advertising?
Well, it's hard for us to predict some of these things that are beyond our control, such as when shelter in place will end and how events will come back. But what we do know is that with a much larger audience, with all the progress that we've made on our revenue products, where direct response advertising is so important to us, coming out of this situation as a stronger company that can deliver even better for advertisers, that when live events do come back, baseball season starts tonight, basketball season starts next week, as people come back to these things, that we'll be in an even better position to help advertisers reach their customers on Twitter.
You've said you're exploring a subscription service. How would that work? Am I going to have to pay for my Twitter? And what would and wouldn't be behind a paywall?
Well, we'd be happy to take your money for it if you'd like, Emily, but I think it's probably more likely that as we experiment around subscription services, that these would be value-add services beyond what people get today. But it's still really early days for us, where we're hiring people, where we're thinking through the opportunities. We'll test them, and when we've got things to announce, you'll hear about them through product announcements and not through job postings. We put something up a few weeks ago, and that got a lot of attention around this.
Meantime, we have to talk about this great hack, certainly the biggest hack that I can remember in all my years covering Twitter. You had the accounts of President Obama, Vice President Biden, Elon Musk, Bill Gates, Jeff Bezos, all compromised in this massive Bitcoin scam. I know that you're working with law enforcement to figure out who is behind this, but with a massive election coming up, how can you assure the American people and people in any country that the integrity of our elections are safe?
We work really hard when we have a security issue like this to both understand it ourselves and then to communicate really clearly what we've learned, so people all around the situation can gain the confidence that we've fixed the situation and that we'll work hard to make sure that it doesn't happen again, and also to help other people learn from it. This one happened to be social engineering driven, and so we want everybody to learn from what we went through so that other people can avoid these same kinds of challenges. These are really frustrating and disappointing when they happen, but the way that we show up at a time like this hopefully helps us build and rebuild trust with all the people around the company.
Now, you've got the CEOs of Apple, Amazon, Alphabet, and Facebook scheduled to testify on Monday before the House Antitrust Subcommittee. Now you have Representative Jim Jordan saying that he wants to hear from your CEO, Jack Dorsey, as well. What do you make of this? And has Jack received a formal invitation?
Well, I'm not sure what to make of it. This one seems to be more about other companies and some of the issues that they face than it does about us. But as you know, our conversations with regulators and policymakers are really important to our work all around the world. We want them to understand our principles, our policies, how we enforce them. And we find when we do that, that everybody's better off for the exchange of ideas that we can have. But I'm not sure that'll tie back to this meeting next week or not.
That was Ned Segal, the Chief Financial Officer of Twitter. Now, we had some breaking news out of the UK. This is PMI, July manufacturing PMI, actually at 53.6, so it's a bit better than expected. Services PMI rising to 56.6. That is better than the 51.5 forecast. Now, let's also get to the markets. I don't know whether we can bring that board up for you, so I show you exactly what's going on with gold. Definitely nearing 1,900. The impact of a lot of the tensions between the US and China is something that's worrying. Bonds edging up, tech stocks also weighing on the European stocks after Intel's warning on a production delay. Now, turning to the business of equality, and 4 former employees of Google are trying to get a court to pass a class action lawsuit. It would allow the 4 women to represent more than 10,000 peers in a gender pay disparity suit against the company. Now, for more on this, we're joined by Bloomberg Quick Takes Jennifer Zabazaja. Jen, when you look at exactly what's been happening so far, where will we be in 2-3 weeks from now?
Yeah, so Francine, class action statuses for gender pay discrimination.
Okay, ladies and gentlemen, I will put stop on profit for yesterday's position that we opened at 116.2, 116.20. And I place stop on profit for 116.18. Okay, so stop on profit placed. If it will reach this level, it will give us £200 in profit, and we will sell maybe at higher level.
to defend their policies, but a lot of eyes will be on what the judge decides in this class certification hearing in December. We saw a group of women earlier this year successfully move forward with a class action suit against Oracle, but alternatively, similar cases against Twitter and Microsoft were denied. So, you know, we're really going to have to take a look at what happens here. Francine?
Jennifer, gaming giant Ubisoft has also been in the news for harassment allegations. I mean, this has been going on for years. It's a family-owned company. Can they really change?
Really been long overdue. And earlier this summer, we saw several women come out publicly acknowledging their experience with sexual misconduct. And as it pertains to Ubisoft, they have apparently a toxic work culture, and women are saying that, you know, now is the time to speak up. So you mentioned, you know, they're a family-run company, but in the past few weeks, we saw CEO Yves Guillemot swiftly take action after these allegations came out. He ousted several executives at the company and promised extensive changes. But, you know, in my reporting on women within gaming, they say it's one thing to say that you're for inclusivity, and it's another thing to actually change your business practices, right? And especially when women make up such a large portion of gamers around the world. And so there's a major incentive for a company like Ubisoft to actually address the sexism that exists within this industry and eventually manifests itself in some of these games, especially at a time when everyone is home and playing games now more than ever. Francine?
Jennifer, thank you so much for joining us. Jennifer Zavajaya there, our Bloomberg Quick Take reporter. And don't miss our Quick Take show, 6 p.m. UK time tonight on Facebook. That's 6 p.m. UK time on Sunday 26 as well on YouTube. Now, coming up, pubs, cafes and restaurants are already open in England. Tomorrow, it's the turn of gyms. What does the future hold for an industry which relies on packing customers into small spaces? Our interview with the chief executive of Pure Gym, the UK's biggest operator, is next. This is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, pubs, cafes and restaurants are already open in England. Tomorrow, finally, it's the turn of the gyms. But what does the future hold for an industry which relies on packing customers into a small space? Well, I'm very pleased to be joined by Humphrey Cobbold. He's the Chief Executive of Pure Gym, the UK's biggest operator. Thank you so much for joining us. How much of a nightmare is it to actually keep, customers safe in your gyms from tomorrow?
Good morning, Francine. Good to be on the show with you. Look, we've got a fair amount of experience of doing this now because we've got gyms that have been open in Switzerland and Denmark for 11 weeks in Switzerland and 5 weeks in Denmark. So we've got pretty used to operating on a set of protocols and procedures that we're very confident are there and set up to keep people safe when they work out. And there are 10 million people, let's remember that, in the UK who are working out in gyms in February of this month, and many of them want to come back again to get in there. So we're confident in terms of what we can do. We put in place procedures to separate equipment, provide plenty of social distancing. You mentioned small gyms there. Actually, most of our facilities are quite large. The average size of our facilities is about 5 or 6 tennis courts, about 16,000 square feet. So we can provide plenty of room for people. We're limiting numbers in the busiest periods with the help of our members, and we're clearly instituting great new cleaning and sanitization processes and procedures that, we've always kept our gyms clean, but we need to hold ourselves to a completely different standard in this new era that we find ourselves in. As I said, we're confident that we've got that right, and we're ready to go in England as of tomorrow morning.
So given you'll have to, accommodate less people in your gyms, what does that mean for revenue and sales?
Well, look, because there's actually plenty of capacity through the whole week, provided our members work with us a little bit, what we found in Denmark and Switzerland is, people aren't crazy. They want to avoid the busier times in places, and people have a bit more freedom in terms of their working hours. So they're coming an hour or two earlier or coming an hour or two later, and we're avoiding those sort of evening and morning peaks to a fair degree. And that allows us, because we've got plenty of equipment, to still offer lots of people the opportunity to work out. And so provided people work with us in that regard, we can continue to provide a great workout at a great price. We're only £20 a month. We provide great facilities for people.
No, I understand how
we can spread
But when do you think you'll get back to normal? I mean, even if people work with you, you're not going to have 100% attendance like you did, let's say, in December 2019, right? So is it going to be at 80%? Will it be 40% capacity? And then you're hoping that as people feel more comfortable, you'll slowly build up to an 80% number?
Well, what we've seen across Europe, we have 240 sites in Denmark and Switzerland, and going to the gym is not dissimilar there to here, is we see that it opens at around 60-65%, and then gradually builds up over time. And actually in Denmark and Switzerland now, we're trading at about 90% to 95% of visits versus the equivalent period in the prior year. And we're expecting a similar trend in England, probably a little bit slower, because the UK's had a slightly worse crisis than Switzerland and Denmark. But nevertheless, we think we'll get back as we get towards the end of the year and early part of next year to a pretty reasonable level of activity, and certainly a level of activity that's economically viable. I mean, nothing's worse than managing with zero revenue. So we'll get back to a reasonable level over time, we believe.
Humphrey, how many more people do you think will actually just want to stay at home and have online classes? And what provisions are you take for catering to those clients that actually still want to be part of the experience but just want to do it at home?
Well, look, we put a huge effort during lockdown into online classes. We made hundreds of classes and exercise routines available freely on our app to all our members, all our ex-members, and actually to anybody who downloaded the app. We think it's great that people want to be active whichever way they want to do it. So we see that as very symbiotic with the core provision of the gym. And of course, some people are going to feel more comfortable staying at home and doing that. All the evidence we've had from members in the markets in which we've opened, including Northern Ireland in the UK, in fact, which we opened 2 weeks ago, is there's lots of things that people do in the gym that you can't do at home. You can't use an Olympic lift platform. You don't have sets of dumbbells or full sets of kettlebells. All the things people want to work out with as part of their routine and discipline, you can get in the gym. And so we'll see people using a mix of those things as well. And I think we'll see many other people coming back to gyms too. I mean, let's remember this is a health crisis where the need for physical activity and fitness and the benefits of that have never been clearer to people. So I think we'll see a lot of people wanting to get more active, and we hope that a number of those will come back to us in the gym, but we're delighted that many will be riding bikes and running and doing exercise at home as well.
Humphrey, thanks so much. Humphrey Cobalt, their Chief Executive Officer of Pure Gym. Now, stocks are falling with U.S. equity futures this Friday. There is concern about these escalating tensions between the U.S. and China. There's also worries that the recovery in the world's largest economy has actually stalled. 5-year Treasury yields touching an all-time low. Gold trading near $1,900 an ounce, close to an all-time high. The dollar also extending the weak slide, and the offshore yuan dipping. Now, gold, as we were saying, been on a rally. We spoke to Mark Mobius about the precious metal.
You know, the fact that the interest rates have gone down, that means these emerging markets rates for their sovereign debt and their corporate debt can also move down. That's one thing. The second thing is the amount of money that the World Bank, the IMF, and all these other organizations are putting into these markets to enable them to pay back their debts and do some infrastructure spending. So that's another thing. And of course, within the countries themselves, they've been increasing spending, taking a lot of their budget. Of course, that means that budget deficits are going to be greater, but that's also been pouring into the markets. So I think it's a combination of these things that have led to an increase. And the interesting thing is that gold has done just as well as the equity markets. I noticed that although gold lagged since the beginning in March this year to now, gold has lagged the S&P 500. But if you look at the 5-year numbers, it's exactly the same. Both have gone up about the same from that about 75% from the low in 5 years. So we're in a very interesting situation where people are looking at stocks to preserve their capital because stocks will adjust to inflation, and also gold. So they're sort of hedging their bets.
I'm glad you brought that up because, you know, when I look at real yields, particularly in the U.S., and then I look at gold, that to me doesn't really say V-shape. And it seems like, you know, in terms of inflation expectations, we're still like 100 basis points off even where we were like a few years ago. So how do you reconcile that?
Well, I think one thing you have to remember that when interest rates are high, people will tell you, oh, you're holding gold. Gold does not pay any interest. But when interest rates are zero or near zero, then gold is an attractive medium to have because you don't have to worry about not.
Okay, I am placing an order for my another position I opened today. And I'm placing an order to sell basically my short at 116.007. Yeah, I usually like to keep these 2 pips in difference because you will get £200 profit, and basically if it change, it's not far away from position when I open. So if it will change and certainly will go up, I will sell short at higher level. So that's it. New order placed to sell my position at 116.
So we look at China, Chinese companies in a separate light. In other words, we look at what their global non-U.S. activity is. So, for example, I don't know whether you've seen it, that Alibaba Financial Services has now teamed up with Vodacom in South Africa to provide financial software and apps. So this is the kind of thing that's happening. In other words, these Chinese companies are moving globally to places where they're not going to be affected by the situation in the U.S. So that's where we have to look.
All right, we'll get to that in 2 seconds, more specifically what you're looking at. But just before we get there, gold, are you buying it at these levels?
Oh, yes, I would be buying now and continue to buy.
What
Because
about
gold is really
silver?
on a run, I think, doing well.
What about silver?
Silver also, because silver, of course, will follow gold. But gold is, of course, the most important.
That was Mobius Capital Partners co-founder Mark Mobius. Now, coming on, even as Brexit negotiators say in public they're far from a deal, behind closed doors they say that some progress is actually being made. So we discuss the latest with our Brexit editor up next. This is Bloomberg.
Okay, position closed on that I opened today at 116.027. Position closed at 116.007, and it gives me £200 in profit. So what I'm going to do, I'm going to cancel my position, my order to sell short at 116.20. This order cancelled. I will hold this position. And we will see if it will move higher. I will see what I can do. Anyway, yeah. Anybody who want to understand this style, how I trade, how our company trades, basically you need to purchase the strategy. Everything is explained there. So get the strategy, and you will see how we trade.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get to the UK politics. This week's talks between Britain and the EU over their future relationship ended with both sides saying they're still far from a deal. In private, though, officials say they're making progress in key areas. Meanwhile, the UK Chancellor, Rishi Sunak, has directed an extra £3.7 billion of virus relief funding to Scotland, Wales and Northern Ireland to help them deal with the pandemic. Joining us now on the phone is our Brexit editor, Edward Evans. Edward, great to speak to you. Behind all the noise, is progress actually being made?
Yes, I mean, for all the theatre yesterday where Barnier is talking about big differences and a deal being unlikely, progress has been made in a couple of really key obstacles to a deal. The European side has recognised that the European Court of Justice is not, for the Brits, is a big problem, and they don't want to impose that on the UK. And on the other side, the British have recognised the structure of the deal needs to be structured in a way that is favourable to the European side. The Europeans are very concerned. They don't want to repeat what they did with Switzerland, where they have a series of mini agreements and no way of retaliating in one area if there's a problem in another. And the British have said that they are cognizant of that issue and that they may be prepared to compromise there. So two big issues there, which they are inching a bit closer towards an agreement. But, and it's a big but, They are still very big obstacles with the level playing field, where these are the rules to ensure fair competition between the two sides, and on fishing. Now, it may be that, that there could be compromise on that nearer the deadline, and we're not at that point yet. In any negotiation, who would give away make a key concession so soon? So it looks like this is going to go on right through to the deadline in October and down to the wire.
Ed, very quickly, how much is the money for Scotland and the other nations? And is that really just to keep the union together, or is it for COVID relief?
Partly, on paper, it is for COVID relief. It is to help them deal with the pandemic. But there are very real concerns on the government side here about the union. Brexit has obviously played into that. Obviously, Scotland voted against Brexit and has been thoroughly opposed to it. But equally, the Scottish government has made a very key point of being different, expressing its differences with the UK government as it's handled the coronavirus pandemic. Now, in practical terms, the results and the policies may not be entirely that different, but the communication here by Nicola Sturgeon in particular has really given the nationalist cause a boost over the last few months.
Ed, thanks so much. Ed Evans there, our Brexit editor. Now, we'll have plenty more Bloomberg surveillance. Tom Keene joins me out of New York. Later, our conversation with Peter Oppenheimer, Chief Global Equity Strategist at Goldman Sachs. This is Bloomberg. Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television. Tit for tat, China tells the U.S. to close its consulate in Chengdu. Mike Pompeo ups the rhetoric against China, calling Xi Jinping a believer in a bankrupt totalitarian ideology. In the U.S., a Republican plan for pandemic aid won't be rolled out until Monday. Meanwhile, the UK Chancellor, Sunak, directs extra relief funding to Scotland, Northern Ireland and Wales. And Intel shares slump amid production delay warnings. The Nasdaq erases its gain for the week on concerns big tech is in big trouble. Well, good morning, everyone. Welcome to Bloomberg Surveillance. I'm Francine Lackland, London. Tom Keene in New York. Tom, gold. I think we may get a 1900 handle, or we're certainly very close to it, and so that will be an interesting psychological level. I like the way you readjust your bow tie right before we see you in camera, Tom.
I haven't looked in a mirror.
So dapper.
I haven't looked in a mirror in 82 years, so, you know, this is when I do it. I see the return here, folks, of the lovely Francine Lacroix, and on a Friday you adjust your bow tie. I did a lavender thing for you today. It's a more sensitive look, Francine. What an interesting market. It is just not a normal July, and just simply, Francine, it's not a normal Friday. Yes, gold almost touching 1900. A little better markets in the last minutes off the better than good PMI data in Europe.
Yeah, so we had some better than expected PMI in Europe, but also the UK. It's not really moving markets that much, but certainly something that we need to keep an eye on. Now let's get straight to the Bloomberg. First Word News in New York City is Karina Mitchell. Hi, Karina.
To you, China has struck back. It's ordered the U.S. to close its consulate in the southwestern city of Chengdu. That's in retaliation for the U.S. decision to close a Chinese consulate in Houston. Chengdu serves as a key U.S. listening post for developments in Tibet. China says its action is a legitimate one and necessary. Meanwhile, President Trump has given in to worries about the coronavirus. He's canceled his Florida nominating convention. That was going to be the biggest event of his re-election campaign. Florida just posted a record number of deaths from the pandemic. The president says he didn't want to take any chances. And there are still differences between Senate Republicans and the White House over the next pandemic relief plan. Majority Leader Mitch McConnell says it now won't be rolled out until Monday. The White House agreed to drop its demand for a payroll tax holiday. Republicans are backing another round of $1,200 checks, plus expanded unemployment insurance. And in the UK, the lockdown eased off and retail sales soared last month. Sales volumes, including fuel, were up almost 14% in June. That's the most since records began in 1996. Sales are now approaching their pre-lockdown levels. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
Karina, thanks so much. Greatly appreciate it. Equities, bonds, currencies, commodities, futures at -12, Dow futures -106. The VIX backs up, but the VIX is not backed up to the range we saw 10 days ago, 3 weeks ago, that 32 to 28 range. We're not there, 27.26. Yes, yields are in, but now they've come back with a PMI data. I don't know what to say about the bond market. Francine mentions gold, $18.94 the ounce. Oil still elevated. Brent crude, the global price, $44 a barrel. Francine, I'll let you talk about foreign exchange. It's Friday. I've run out of energy.
Okay, gold, first of all, you know, it is close to an all-time high, so I'm really looking at that almost every couple of minutes, just in case it changes. The dollar extending the week slide. The offshore yuan is actually dipping. Overall, Tom, look, stocks are falling in Europe. They're falling in U.S. futures. And this is because markets are now worried that the recovery in the U.S. has stalled. Yes. And they're also worried about these, escalating tensions between China and the U.S. So Beijing is following through on its threat for retaliation. China has now ordered the U.S. to close its consulate in Chengdu. The move comes after the forced closure of the Chinese mission in Houston. Well, Bloomberg's Beijing Bureau Chief Sharon Chen joins us now from Chengdu. Sharon, the retaliation, was a closing of the consulate as expected. It wasn't the one that would have hurt the U.S. the most. Is that it? Or are we, expecting a further escalation?
Well, I think the ball is in the U.S.'s court now because, this was a response from China to the U.S. Closing down the Chinese consulate in Houston. But, the U.S. and China are fighting wars on so many fronts, trade, Hong Kong, Xinjiang, Taiwan, it's just Huawei. There's just so many things, and all of these areas, there could be escalation on any front at any time.
Sharon, when you look at exactly what this means for trade, you had some pretty strong words from Mike Pompeo on China. How will the Chinese leadership take that?
Yeah, I mean, it was obviously very inflammatory, and it's really feeding into this anti-American sentiment that is already spreading in China. We were talking to people in Chengdu today about how they feel about the U.S. consulate closing, and in general, people are kind of curious, or they don't really know what's going on, but they do know that the tensions are rising. And we spoke to one person who lives near the consulate, a Chengdu resident, who said that he thought that it was great, like it was a proportionate response, and he said it was the U.S. that first broke this relationship between the U.S. and China.
Sharon, there's a backstory here, and that is that Chengdu is north of Hanoi, and Lhasa, Tibet is north of Bangladesh. It's 800 miles directly west of Chengdu, and Chengdu is how you get to Tibet. With this action, have we precluded Americans from going to and their interest in Tibet?
I mean, Tibet is basically, it's very difficult for diplomats to access it anyway to begin with. But yeah, I mean, the consulate here is a way for the U.S. to keep tabs on Southwest China, and that has now been lost.
Sharon, one final question, if we could, with the connection we've got, and I believe we'll see you in the next hour as well. The turmoil into the weekend begs for another response. From where you see China, and you're reporting on China from Beijing, is this the final response, or do we just assume there'll be something next?
I mean, it's very hard to tell, but I don't think anyone thinks that this is the end. I mean, the tensions are really high right now, and these moves of closing the consulates, they've been the most extreme in many, many years, and I don't think it's going to stop here.
Thank you so much, our Sharon Chen there, Bloomberg's Beijing Bureau Chief. Now, up next, Patrick Armstrong, a Plurality Wealth Management Chief Investment Officer. We'll talk to him about U.S.-China tensions. We'll talk to him about gold. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They move the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
Good morning, everyone. Bloomberg Surveillance. Francine Lacroix in London. I'm Tom Keene in New York. We've got a number of angles today. We just spoke to Chengdu, to our Sharon Chen in Chengdu, Elizabeth Economy to join us later, and then Ambassador Haas scheduled to be with us here in a few hours on that important story. Of course, we've got the stimulus issue in Washington. We've got the follow-on from the stimulus, if you will, in Europe. And right now, on the markets, so they've been on really front and center here. Patrick Armstrong joins from Plurimi Wealth. Patrick, with the market turmoil, with the new agitation, a better than good market, and then this pullback that we've seen over the last 2 days, have you made any changes to your portfolio, to your allocations?
We've not made any changes. We're sticking with what has been winning, really. The quality companies, the growth companies, we think will continue to rise because when $1 in 10 years is worth the same as $1 today, companies that can double their earnings over that period are worth a lot more than companies that are going to see their earnings flatline or deliver low growth or negative growth. So we're long healthcare companies, technology companies, companies with good balance sheets. We're short some of the indebted cyclicals, the autos, and some of the banks that don't have the investment banks divisions.
There's a whole belief, and certainly Francine and I have seen this through the week, of people just flat out afraid to participate. We see it in the flows, the retail flows, institutional flows as well. What do you say to people who say, I'm out of the market, I'm in cash?
I can totally understand the thought process that leads you to that, because I wake up many mornings thinking that's what I've got to do. And then I look for alternatives. Where do I put my money if it's not in equities? So in March, we allocated towards credit. We were getting big credit spreads. Those credit spreads have gone. Treasuries, you're losing money on a real basis. In Europe, you've got negative yields. So equities are not cheap by any means. There's going to be pullbacks. There's air pockets because there's no valuation support on traditional measures. But that's the one area where well, not the one area. I also like gold a lot too. But that's one area anyway where I do see where you'll create real growth above inflation over the next decade.
Patrick, how much do you like gold? I mean, when does gold get a breather?
Well, gold, if you wanted to write the recipe for the perfect backdrop for gold, you almost have everything right now. You've got M2, money supply growth is up 24% over the last year. So in the periods of the 80s when there was massive inflation, M2 was growing at 15, 16% per annum. So 24% is just completely unprecedented. You've got zero interest rates, so there's no opportunity cost for holding gold. You have massive geopolitical risks. You have central banks who probably want to de-dollar their reserves because of different issues they're facing with the United States. You've got political risks in the United States as well. And debt to GDP of the G7's going to hit 127%. You either have to have austerity or a debasement of currency to get out of those kind of debt to GDPs. You're not going to just grow your way with real growth out of that kind of debt to GDP. So I think debasement is the end game for most central banks, and gold preserves value in that kind of environment.
But Patrick, so what's the fair? I mean, I'm not talking about fair value. Where does gold go next? Is the sky the limit, or is there a plateau? Like,
well, I
think a figure.
Well, it depends how quickly the debasement strategy happens. But I think what you've seen is with negative real yields, you get no yield in gold, but you probably will preserve your purchasing power. So as inflation is generated and as fiat currencies are debased, gold just goes up as measured in those fiat currencies. I don't think you're going to change your wealth by owning gold particularly, but I do think you can preserve your wealth in gold. And gold, I expect to be at $3,000 3 years from now. And that's just because governments and central banks don't have many alternatives except to grow nominal GDP. Real GDP is going to be very hard to grow. I think it'll be much easier for them to create some inflation and generate some nominal growth, which will let them deal with their debt to GDP ratios.
What does a $3,000 gold price do to our desire for
This is something for thoughts. As you can see, I put on the left side, we decided to place pictures. Yeah, every time when we sell something, we make profit. If person, let's say, join our stream on middle of the day or 5 hours, because we stream from 8 o'clock until 10 o'clock. So what I can say that basically they can see when we sold and what pairs were sold. So on the left screen, you can see, it's right here, you can see the right now what position and what we sold. So if anybody likes it, please thumbs up, or let us know if it's really worth it to keep going with this. Anytime if we'll sell something new, the banner will move up or down. I don't know, I'm not technical with this, I'm a day trader, but our technicians will do something that it will show you every day what we sold and basically how much we made. Okay, let me know if it helps you to make new trades or to follow our trades, if you will not get bored from all these screens. Okay, cheers guys.
Over the last 30 years, I've managed through a number of crises myself, but nothing I've ever seen has ever been quite like the crisis we have now. I want to talk to CEOs and see how they're living through this crisis. Who is going to really manage their company in a way that people will remember it? That's what I want to know. This is Leadership Live.
The China consumer has become so important to many U.S. brands and small businesses because that's where they see growth and the ability to benefit in the post-COVID environment.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Bloomberg Surveillance, good Friday morning from London, from New York. Really interesting story flow this morning. And of course, we're watching the markets after the pullback yesterday, continued pullback this morning. Futures negative 12. And now with a business flash in New York City, here's Karina Mitchell.
Tom, shares of Intel are falling, the company revealed after the bell that a new chip production process suffered another delay. That news boosted shares of rivals such as Advanced Micro Devices and Taiwan Semiconductor. At issue is a new method for cranking out smaller, more powerful chips. And it is the latest sign that the coronavirus is wreaking havoc in Hollywood. Disney has canceled the August release of the widely anticipated film Mulan. It also delayed future Star Wars and Avatar movies by 1 year. Meanwhile, the largest U.S. theater owner, AMC, has delayed its reopening until mid to late August. And for the 9th quarter in a row, there were net outflows at hedge funds. According to eVestment, investors pulled out more than $42 billion from hedge funds around the world in the second quarter. For the year, more than $55 billion has been withdrawn. And that's the Bloomberg Business Flash.
Karina, thank you so much. Now let's get back to the markets and let's get back to Patrick Armstrong, Plurimi Wealth Chief Investment Officer. Patrick, we were talking a little bit before about gold that you like so much. Does that also extend to silver, or is silver a slightly different function?
It's something I looked at. I wish I would have bought it. We started looking at it a couple of months ago just because the gold-silver ratio really got blown out very wide, probably the widest it's ever been. But I think any precious metal, silver, probably makes just as much sense as gold. I think gold, what I like about it is it'll be used as an alternative to the US dollar for reserve. We won't get there with silver, but there is a loose link between the two. So if you like gold, you probably like silver as well.
What are you constructive on right now? I don't know whether the EU recovery fund over the weekend makes you buy European assets more. It seems, a lot of people are doing that, and I wonder whether it's going to be a crowded market.
It's changed our view on the euro. So I think the euro probably ends the year at around 120 versus the dollar. Before that, we were expecting basically no change between the euro and the US dollar. So what I think it's done is it's removed some of the fragility. It's answered some of the questions that for the euro to be sustainable and viable, you need fiscal basically integration. And we don't have that, but it does show in times of stress, when there's emergency, when it's needed, you all have a form of fiscal integration. And I think that addresses some of the weak chains in the euro. So for us, that removes one of the question marks. I don't know if there'll be flows into the euro massively, but I think central banks and pension funds, endowment funds who are looking at euro, that's one of the questions that's now answered.
Investing 101 with Patrick Armstrong this morning. Patrick, if you like gold, and you suggest an inflationary tendency and a suggestion of a review of nominal GDP, not inflation-adjusted GDP, does that mean by definition you like equities?
I like equities, and I like the growth equities because in financial repression, when interest rates are zero, I think companies like Alphabet, Facebook, Apple are going to grow earnings over the next decade. I think companies like General Motors will see their earnings fall over the next decade. And when a dollar 10 years from now is worth the same as a dollar today, you pay up for growth. So it's unanswerable what the multiple should be. 30 times isn't cheap by historic measures on earning, but that's where they're trading. Okay. I think it's...
Well, this is really important. I want you to rationalize the acquisition of shares today of a 30 multiple toothpaste company. How do you pull that off rationally?
What's the 30 multiple toothpaste company?
I don't know which one it is. It's just a given stock. A basic consumer company, a 25 multiple, 28 multiple, 30. Who's counting?
For me, I want to pay 30 times earnings if I know the company's got a defendable monopoly or oligopoly position. And I think companies like toothpaste, no way. Companies in the technology space, companies in the healthcare that have innovative treatments for cancer, for COVID-19, things like that is where I'd pay 30 times earnings for. So the consumer staple stocks don't attract me, actually. They're trading at those kind of multiples because they have sustainable growth. Okay. I don't think growth, and it's not defendable margins.
Based on the definitions you just said, where's the next Amazon?
That's a very good question. People are pricing Tesla as if that's going to carve out some sort of monopoly position, maybe in self-driving cars, or it'll be the only auto company in the future. For me, I don't know enough about the earnings and the cash flow, how we get to a Tesla multiple where we are right now, but the next Amazon is a very big question. I don't know where it is right now. If you find someone else who does know, make sure to send me that link as well.
Okay, Patrick, if you look overall at some of the valuations in technology stocks, are we in bubble territory?
I think we're in a bond bubble, and that's created very lofty valuations in technology companies. So I don't think it's a bubble, because I can see why Alphabet at 30 times earnings will be trading at 18 times earnings in 10 years' time if we do have a normalization and higher interest rates. So I can see how that gets there. Other companies, I think, are more expensive. I'd much rather own a technology company that's growing, paying 30 times earnings, than General Motors or, I almost said Royal Bank of Scotland, NatWest now. It's another company we're short. These kind of companies don't have anything indefendable in terms of profit margins to generate recurring growth in earnings. So defending earnings is the best they can hope for. I think the traditional banks suffer massive headwinds from no interest rate margin. The central banks are making the investment banks do very well on the bond trading side of things. But I think it's worth paying up for quality and for growth where you can find it.
Patrick, thank you so much for joining us. Patrick Armstrong there of Plurimi Wealth. Now, stocks are definitely falling here in Europe, but U.S. futures are also feeling a bit of pressure. This is over escalating Chinese-American tensions. We saw the tit for tat in terms of consulate closures. There's also a bit of worry out there on the market that the U.S. economy has stalled. 5-year Treasury yields touching an all-time low. Gold, we were talking about it with Patrick Plurimi, trading near $1,900 an ounce. That's close to an all-time high. The dollar extending the weak slide, and the offshore yuan actually dipping. Coming up, we'll talk a lot more about tech valuations, and then later, the Intel chief executive, Bob Swan. You don't want to miss that interview to talk about what's coming next for the tech sector also as a whole, and for Intel specifically. That's 11:30 a.m. in New York. That's 4:30 p.m. in London, and this is Bloomberg.
Okay, guys, I'm placing a new order to sell short euro. The price I'm looking at 116.065. So this is the price. Yep, 116.065. So order placed. Let's see.
D'un mouvement qu'on ne lâchera jamais, on ira jusqu'au bout. Ça fait 4 ans que nous sommes là, nous n'avons pas peur. Ils ont les armes. Nous sommes devenus des soldats malgré nous. Hein. Face à nous, c'est une machine de guerre qui n'a ni sentiment, ni état d'âme, ni remords. Oui, c'est un mouvement qui se prend, c'est le mouvement du comité Adama, de la nouvelle génération Adama. Aujourd'hui, moi je suis là, nous sommes là, on changera peut-être pas le monde du jour au lendemain, mais on changera des choses.
2% inflation goal is symmetric, which means we should overshoot it. We're having a difficult time doing that, like all developed economies. I'm supportive of the idea of letting inflation get above 2% before we take any action with respect to the Fed funds rate.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Tom, we're looking at gold. We're actually looking at gold because it's trading near $900 an ounce. So that's close to a record all-time high. The dollar right now actually extending the week slide. Offshore yuan dipping. So I wanted to show you exactly where we were on that, 701. And then stocks in general here in Europe are falling in tandem with U.S. equity futures. There's concern about escalating tensions between the U.S. and China. There's concern.
New short position opened at euro at 116.065.
Market does switch finally. We've had 2 days of lower yields, and we really come around. The U.S. 10-year 0.59 to round it up to. So a little bit of higher yields again off that enthusiastic economic data as well. I can't tell you exactly when, but I am certain more than anyone that is associated as a Fed official, Narayana Kocherlakota has nailed it. Maybe the events didn't turn out the way he or anybody else thought, a horrific pandemic, the economic slowdown, but I have the clearest memories of 100 days or maybe 120 days ago, Kocherlakota sticking his neck out and saying, Fed, do something and do it now. Here is a former president of the Minneapolis Fed.
The Fed should be doing all that it can to stimulate the economy in the current setting. That will further both their current mandates in terms of trying to get inflation back up to 2% and trying to lower unemployment from where we are today. And unfortunately, I don't see. I see unemployment rising and not falling, even with Fed stimulus. So. Now, the point of my piece was that would help on a third mandate, which has been proposed by the Biden campaign, which is to shrink the gap between black and white unemployment. I think that's a valid goal in and of itself, but then the pursuit of that actually would just be beneficial for the economy because that gap tends to be low when unemployment is low.
Narayana, good morning from London as well. It was a great opinion piece, and you basically lay out why you think the Fed should also target racial equality. How exactly, concretely, can they do that?
Well, I think the Fed has one tool, right, which is interest rates, and so, but I think the point is that if it paid even more attention to the employment mandate than it has over the last 30 or 40 years. It would do more to further black-white equality in terms of lowering the gap between black and white unemployment. The reason that gap tends to be high is only because unemployment itself is high. And if the Fed is willing to have easier monetary policy, say, to be concrete about it, I think if you look at 2015, when the Fed initiated the rate hikes, overall unemployment might have looked low, but if you look at the gap between black and white unemployment, that still was high. And so looking at that would have said to the Fed, okay, there's another reason on the table where you shouldn't be tightening policy.
So I wonder how this plays into the conversation with real yields, which continue into negative territory. The last time they were this low, we were in the whole QE infinity world that you were in when it comes to the Fed. So I just wonder how much more QE infinity are we going to need to kind of keep yields this low, and do real yields sink even lower at this point?
Yeah, I think the Fed is going to be doing what it can to push real yields even lower, I think, even in longer-term yields. The challenge right now is we saw unemployment insurance claims come in earlier today. The U.S. economy, I think, is under severe challenges, and I think those severe challenges come from one source, which is our public has not been what it should be. As a result, we see this surge of cases around the country. Unfortunately, surge of deaths now around the country. Until public health is where it needs to be, we're going to continue to face significant challenges in the economy, and the Fed is going to have to do whatever it can to provide support.
Narayana, what do you think should be in the next stimulus bill? So do we have a good enough understanding of the pressures that the U.S. economy is going through? And are all sides going to work together to make sure that in the stimulus, it safeguards the weakest points in the economy?
Yeah, I think that the challenges, I think, are that you're going to be facing a lot of people who are not going to be able to find jobs or are going to be losing jobs. You want to provide support to them in terms of spending. And you got to provide, even if you haven't lost your job, you might be worried about losing your job, and that's going to lead you to cut back on spending.
Well, that was Narayana Kocherlakota, the former Minneapolis Fed president, speaking to us yesterday. Now, let's get straight to the Bloomberg First Word News in New York City. Here's Karina Mitchell. Hi, Karina.
Fran, thank you. China threatened to retaliate for the U.S. closing its consulate in Houston, and now it has. The U.S. has been told to shut its consulate in the southwestern city of Chengdu. It's a key U.S. listening post for developments in Tibet. Beijing says the move is a legitimate and necessary response to U.S. actions. Meanwhile, it is getting more difficult to get a clear picture of the coronavirus pandemic here in the U.S. The problem, testing shortcomings. Health officials warn that new infections may be significantly undercounted. The government's testing czar told Fox News that while 67,000 new cases may be reported each day, the reality is more likely about 200,000. And resorts in the Caribbean are reopening to tourism, but not to Americans. Tropical vacation spots across the region are giving Americans the cold shoulder. Authorities are afraid they'll spread the virus. This week, the Bahamas will begin barring commercial flights and passenger ships from the U.S. And a judge in Portland, Oregon, has barred federal agents there from arresting or using force against journalists and legal observers. That comes after more than a dozen of them claim they were tear-gassed or shot with munitions. The Trump administration has defended sending in the agents, saying local officials couldn't keep protests under control. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
Thanks so much. Coming up, we look at China. Elizabeth Economil joining us with the Council on Foreign Relations. And then her colleague, the president of the CFR, Ambassador Haas, will join us here in a bit. His wonderful new book, The World, my book of the summer. Stay with us for Haas later this morning. This is Bloomberg.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
Bloomberg Surveillance. Good morning, everyone. From London, from New York, Francine Lacroix, Tom Keene. Lots going on. Really focused on China. We'll play that up big here. But right now, the conversation of the weekend, which is gold, gold, gold. Where were you $500 an ounce ago? Where were you $1,000 an ounce ago? If you watch Bloomberg Surveillance, you know, we had many people come on and say, buy gold. We need to reset. And we do that with a gentleman from England by way of Australia, Macquarie Group's Marcus Garvey joins us now, their commodity strategist. Marcus, congratulations on your call here. How can you sustain enthusiasm for gold after such a large move?
I think that's a very fair question, and clearly as we get up towards the prior all-time highs, there is the risk of a bit of a correction and a pullback. But I think the underlying dynamics that have supported this move are still very much in place. And are likely to continue. So we think that a move beyond here, through that 2011 high and up towards something like $2,000 an ounce is very plausible. That is probably going to be a bit of an overshoot, and so you're not necessarily going to sustain a price that high. But I think with the momentum that we have at the moment, there's a good chance that we make that next leg.
As you well know, Marcus, the bid on a tangible asset is a factor analysis. It may be jewelry, it may be the kiosks of Dubai, et cetera, or the central banks, et cetera, or it can be the ease of purchase of a tangible through new financial products like ETFs. Is gold popping at the margin because it's so darn easy to buy?
I think that's certainly a tailwind for it, in the sense that it's easy for people to increase their allocation to it. And it is very much that the primary driver of this is, I think as we've discussed before, is financial. Jewelry sales have been weak year to date, particularly in emerging markets, and the major driver are ETFs, which you mentioned. And I think one of the things that's now likely to kick in if we do get this further leg up towards that sort of 2,000 big number is that you're going to see futures length go back towards its prior all-time highs as well, because you're going to see things like systematic momentum buying pushing the market towards those sort of big round numbers.
What exactly is sustaining gold? And talk to us about gold and silver, Marcus. Is it one and the same thing, or is silver a little bit different right now?
I think two very good questions there. So I think in terms of what's sustaining gold, clearly the principal underlying support is what we've seen in the real rates markets, with things like 10-year tips going below minus 90 bips. As we get into that sort of towards minus 1% territory, clearly the opportunity cost of holding gold has collapsed. And that's something that's very supportive for the yellow metal. For silver, you do have that precious metals characteristic also providing a tailwind. But one of the things, if you look at the history of silver's performance, and particularly silver's performance on a ratio to gold, it tends to outperform when you see an improvement in industrial activity and when you see risk on market conditions. I think that's one of the nuances that we need to think about for this precious metals rally, is that although there's clearly plenty of uncertainty in the world, we have been rallying with risk markets. Gold and silver have been picking up with equities. And that's a particular tailwind for silver. So we're not that surprised that silver has managed to have this big catch-up over the past couple of weeks, having lagged, because we've seen it come alongside things like a recovery in the global PMIs and continued strong performance from global equity markets.
But Marcus, is the rally in gold symptomatic of investors that actually don't think central banks can do enough to deal with the current situation in the economy, or is it in a frenzy just because people talk about it?
I think there's a few different reasons that different types of investors have increased their allocation. So I think if you're looking at some of the money that's come in kind of latterly in the kind of the most recent couple of weeks, that is more, I think, momentum related money that is kind of joining the rally at a later stage. If you're going back to the earlier stages of this, if we go back to, say, after that March correction, I think that's money that's more been associated with taking a slightly more strategic look at what we've got in terms of global central bank policy and what that means in terms of the outlook for real interest rates staying lower for longer. So I think you've got different investor groups making different kind of strategic versus tactical investment decisions.
Great. Thank you so much for joining us. Marcus Garvey there, Macquarie Group Commodities Strategist. Now, later today, we'll be speaking to Hans Vetsburg. He's a Verizon Chief Executive. That's 11 a.m. in New York. That's 4 p.m. in London. We'll ask him about mergers and acquisitions and many other things. This is Bloomberg.
Does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
When we went into this quarter, we knew that it was going to be very challenging.
The mantra was, if it costs money, the answer is no.
The situation out there is still very challenging and very difficult to predict. So we should never be complacent.
We'll have to watch carefully to see if there is a true significant second wave in the second half.
As we look forward, we think that the results in the second half year will improve.
We actually don't have the courage to give a real firm guidance for the second half.
There's going to be stimulus in the market. There's going to be political uncertainty. So I think there are a few ingredients in the second half year that can truly drive volatility.
Those were some of the European chief executives from the past week discussing the second quarter and their outlooks amid the uncertainty that lies ahead. Now let's get straight to the Bloomberg Business Flash. In New York City is Karina Mitchell. Hi, Karina.
Fran, about 400,000 airline workers around the world have been fired, furloughed, or told they'll lose their jobs because of the coronavirus. That's according to Bloomberg calculations. The biggest losses have been in North America, Europe, and Asia. Meanwhile, job losses in related industries such as aircraft makers, airports, and travel agencies could reach 25 million. And Brooks Brothers has gotten a $305 million bid backed by Authentic Brands and mall owner Simon Property Group. The offer would keep the bankrupt men's clothing chain in business. Authentic owns another well-known clothing retailer, Barney's, New York. And there's a newcomer to the ranks of the 5 richest people in the world. Mukesh Ambani, chairman of India's Reliance Industries. According to the Bloomberg Billionaires Index, Ambani has a net worth of $77.4 billion. He just overtook Steve Ballmer for the 5th spot on the list. Reliance Industries stock is up 135% since March. Ambani's fortune has risen almost $19 billion this year. And that's a Bloomberg Business Flash.
Corinne, thanks so much. Now, earlier this week, European leaders came together to agree on that historic recovery fund. Let's now dig into some of the stipulations a bit deeper with Sylvia Merler, Algebris Policy and Research Forum Head of Research. Sylvia, thanks so much for joining us. I mean, you have some fantastic research out there, and also some of your threads on Twitter are really ace, so I urge everyone to go back and look at them. But Sylvia, overall, there was a misunderstanding or questions about the rule of law, about whether this could actually be used. Is the overall package enough in terms of the money transferred to really help some of the countries in need, or is it just more of a political will?
I think it's both, really. I mean, this is an historic step symbolically because it overcomes in just one go 2 historical taboos of European integration on the fiscal side, one of which was obviously the opposition to large-size common EU issuance. This is now going to happen to the tune of 750 billion. If you look back to the previous decade, the capacity that the US to issue debt was used only very marginally, 70 billion in total over 10 years. We're now going to do 10 times that over 3 years. And the second taboo is obviously the opposition to explicit net fiscal transfers that has long been a red line in the north of Europe and is also going to go because the grant component within Next Generation EU actually allows for net fiscal transfer. So this is really, really significant.
Sylvia, what are the countries, I mean, what does Italy get out of this? Is Italy the one that had the most to lose?
Okay, ladies and gentlemen, I place stop on profit for my another position on euro, and it will be 116.04. If it will go back up and if it will close above this position, we will have £200 in profit.
Increase own resources, and this is probably the most important discussion that we will have in the coming months. But even under a very conservative assumption, so assuming that Italy will be liable to repay its own share in the EU budget of the grant component, that would be about 50 billion. So you have a net transfer of 30 billion. And this rightly may look small compared to the size of the Italian economy or even the size of the Italian debt. However, Italy is the only net contributor to the EU budget that becomes a net beneficiary of the grants under Next Generation EU. So I think it's the switch of the sign that is really more symbolic in this case, in the case of Italy, in showing that there is really fiscal solidarity going on, maybe for the first time as far as Italy is concerned.
Sylvia, good morning from New York. In the world of Davide Serra in banks and financials, or the world of Alberto Gallo in bonds, they're looking for the next indication of the next tranche. Do you just assume when all the dust is settled that the EU is going to have to once again go back to further stimulus?
It's difficult to say now, I think. This is definitely going to help as far as bridging the very sizable gap that we had with the US in terms of the stimulus that was out there. I mean, the European Central Bank has been very active in a way that's comparable to the Fed, but definitely on the fiscal side, the EU, once again, we saw during the global financial crisis and the Eurozone crisis, has been doing everything at the national level, and particularly this time because countries that had been hit very hard during the previous crisis were very constrained in terms of the fiscal space. You really risked having a very asymmetric recovery at the national level, and you see that very clearly in the spring forecasts from the European Commission. So this is going to help avoid that this happens, I think, going forward.
A euro at 116, George Saravellos at Deutsche Bank models out a 120. At what point does strong euro change the political economic calculus of what the EU is doing with stimulus?
I think to be honest, we're far from there because the situation in Europe now, if you look at the forecast, this comes out very, very clearly. 2020 and possibly 2021 are not going to be are going to be very difficult years, particularly in some of the quarters of the Union. One thing that I would like to say on particularly monetary policy, this is important. When I was talking about asymmetry is really at the core, I think, of the consideration also of monetary policy. And monetary policy itself, if you look at the previous 10 years of the euro, contributed to drive the development of asymmetry, but then the adjustment that we had following 2010 actually led to massive convergence. So today, monetary policy doesn't have the problem that it did during the previous decade of European integration, that it was dealing with very different economic situation with a single rate. Today, countries are possibly closer together than they have ever been in the past, and so this is why avoiding that asymmetry comes back again is so crucial in the context of the European recovery, also to ensure that monetary policy is really going to have an even effect across the board.
Sylvia, thank you so much for joining us. Sylvia Merle there, the Algebris Policy Research Forum Head of Research. So we'll have plenty more, of course, on the EU Recovery Fund, as there seems to be quite a lot of people, Tom, that hail it as a great thing. This is what we heard from Goldman. This is over the 10DB scandal. We understand that there's an agreement, Tom, between Goldman and Malaysia, and that is said to include a $2.5 billion in cash, Tom.
Excuse me. Yeah, it is a big move by Goldman. We'll have to see the fallout from this, particularly at the executive level. In our next hour, Russ Kostorich joins us from BlackRock and your interest in these markets. Stay with us. This is Bloomberg.
Opportunity knocks at the door. Don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with LACWA.
see coming. Some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
This morning, Chengdu, we have a problem. After the closure of the Houston consulate, the Chinese, they choose Chengdu. The consulate, the American link to Tibet. Republicans, well, they agree to disagree. Chaos on stimulus. This is August beckons. The economy struggles. Well, it's over. Go to cash. Wait, we said it's over in April. We said it in May, June. And now we're saying it in July. Futures in -9. Good morning, everyone. This is Bloomberg Surveillance from New York, from London. Francine Lacroix and Tom Keene. Interesting conversations, I guess, on China, Francine. There's a really interesting side story here, and that is your United Kingdom. I mean, it's not just the U.S. in Beijing, Washington in Beijing. It's also Prime Minister Johnson in Beijing. What's his view?
Yeah, so there are a couple of things actually going on in the UK, Tom. One, you're absolutely right. So Mike Pompeo has just left the UK a couple of days ago, and him and the Foreign Secretary Dominic Raab seem to be very close in, for example, condemning Huawei. This is an issue for China. There's also a tussle over the security law that China did in Hong Kong, with the UK offering to suspend the extradition treaty with China, something that China hasn't taken so well, and so punished the UK by not showing their Premier League matches on Chinese state TV. So something, I know, don't touch football. So it is something that actually, could simmer. But we had a great story on the Bloomberg yesterday, Tom, saying that under President Xi, we could just see a China versus US, a China versus UK, as he's ready to take on the world to be seen as being the strong man back home.
No, it'll be interesting to see. I'll be emailing our Chinese brethren with Tots Crystal Palace here. I believe that's on Sunday. Right now, with our first read news in New York City, Karina Mitchell.
Tom, good morning. Bloomberg has learned that there's a settlement in that case involving Goldman Sachs and Malaysia's troubled wealth fund, 1MDB. Malaysia would drop all criminal charges against the bank. In return, Goldman would pay $3.9 billion of reparations for its role in raising money for the fund. And China has struck back. It's ordered the U.S. to close its consulate in the southwestern city of Chengdu. That's in retaliation for the U.S. decision to close a Chinese consulate in Houston. Chengdu serves as a key U.S. listening post for developments in Tibet. China says its action is a legitimate one and necessary. And President Trump has given in to worries about the coronavirus. He's canceled his Florida nominating convention. That was going to be the biggest event of his re-election campaign. Florida just posted a record number of deaths from the pandemic. The president says he didn't want to take any chances. And in the UK, the lockdown eased off and retail sales soared last month. Sales volumes, including fuel, were up almost 14% in June. That's the most since records began being capped in 1996. Sales are now approaching their pre-lockdown levels. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Tom.
Karina, thanks so much. Greatly appreciate that. Let's look at equities, bonds, currencies, commodities on a Friday. Maybe not the nuance of yesterday, but this could heat up as we go to the opening. Futures -9, Dow futures -49. The VIX comes back from the glorious 23-24 level off the ugliness yesterday, 26.94 on the VIX. I'll let Francine talk about gold. She owns it up to her eyeballs. I don't own any because I'm in triple leverage, all cash. Bond yields mixed, even a little bit higher here off of the lower yield regime of the last 48 hours. Francine?
Tom, we don't trade here in Europe. I mean, the gold I have is my bracelets that belong to my grandmother, but there is an attraction, certainly for Italian women, to gold. This is what I'm looking at overall. So gold is the one that, if you reach that psychological level of 1,900, that's an all-time high. I don't know what happens after that, but we've been speaking to a couple of technical analysts on that. The dollar, as Tom says, extending the week slide, although today it's moving sideways. I'm looking at offshore yuan, again, dipping. European bonds also falling after U.S. Treasuries turned lower, Tom.
Very good. Chengdu, where is it? We don't know it because we go to the Pacific Rim and say we went to China. Maybe we wander out to Beijing, and that's about it. Chengdu is not far, far west, but it's on the way to west, with Tibet further west by a good 500 miles, a 2-hour plane flight as well. But what we know is Chengdu, well, that's the entryway to the pandas, the entryway to Tibet, and the entryway to a Western China. Sharon Chen, our Beijing bureau chief, is in Chengdu. Sharon, what has changed in Chengdu on this Friday?
obviously, there's a lot of attention on the U.S. consulate after the announcement that China is forcing it to shut down. There were many, it drew large crowds outside the consulate, lots of curious pedestrians looking to see what was happening. We didn't actually see any American diplomats leaving or any real activity, but security was extremely tight. There were dozens of policemen, army personnel, security agents patrolling the street outside the consulate, checking people's phones, checking their IDs, not allowing anyone to take pictures or videos. Everyone was just kind of on edge and waiting to see what's going to happen now that the announcement has been made.
Sure. What will happen next? I mean, is this it? It's one for one, or does this escalate?
I mean, it's very hard to tell. I mean, on this specific issue, the U.S. closed the consulate, China's closed the consulate, but there are so many other issues that the U.S. and China are in combat over. Everything from trade to Taiwan, Hong Kong, Xinjiang, Huawei. This is such a long list of things, and escalation could happen on any front at any time.
Sharon, explain to us the distance from Beijing to Chengdu, the distance from Shanghai to Chengdu. I mean, I think all of our viewers and listeners understand the distance from, say, New York or Washington, to name the city, or even the same in Europe and the United Kingdom. How far away is Chengdu for the Pacific Rim?
Sorry, I don't really know the numbers, but like you said, Chengdu is in the southwest, and it would be closer to Shanghai than Beijing.
I mean, it's a fascinating idea. What are the businesses of Chengdu that we risk with this economic sequestration? What is the economics or the finance that we will miss?
Yeah, well, I mean, I think with the closing of the consulate, the main impact is on kind of the people-to-people relations between the U.S. and China. It's a big place where people go to get their visas processed. And right now, there are all these students and these workers who've been locked out of the U.S., and that obviously has a huge impact. But, Chengdu is also well known as a tourist destination. It's very well known for its pandas and kind of for its cultural significance.
Sharon, give us a sense of what President Xi is doing right now after Mike Pompeo, called him some pretty bad words. Does President Xi take offense, or is it just, this is kind of business as usual because it happens and he doesn't take it too seriously?
I mean, President Xi, his demeanor and his approach is obviously very, very different from what Trump would do. So it's very unlikely that we get some kind of reactionary statement or something that's kind of as inflammatory as what Mike Pompeo said. It's always very measured, and, when the Chinese speak, it's always in this kind of coded language, and they use terms to signify how serious they're taking it. I mean, I wouldn't really expect some kind of explosive statement.
Sharon, thank you so much. Sharon Chen with Bloomberg in Beijing, and of course reporting here from Chengdu. Coming up, we've got some wonderful conversations this morning. Elizabeth Economy scheduled to be with us later on. Ambassador Haas will join with the Council on Foreign Relations. His book, The World, my book of the summer. Stay with us. This is Bloomberg Futures, -6.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
None of us are safe until all of us are safe. We need to have a global approach into handling and fighting COVID-19, a global pandemic. Part of this, of course, finding an effective vaccine.
Bloomberg Surveillance. Good morning, everyone, from London, from New York. A Friday, an eventful Friday after a really odd week. No other way to put it. Just as a note, Greg Valliere just publishes on the chaos in Washington. We'll address this here in a bit. Really remarkable what we're seeing in Washington with the path to stimulus here to August seeming blocked right now. Russ Kosterich joins us. He's with BlackRock. Russ, let's rip up the script here right now. What a debacle yesterday for the Republicans in Washington. How does that fold into your belief in the equity market? If we struggle to get stimulus, what does that signal for equity investors?
Well, Tom, obviously it's going to be a challenge. I still think a package is going to get done. But, you know, as you point out, this is critical for the market because it's critical for the economy, because it's critical for household spending. And this has been such a strange contraction, and one of the silver linings that really has helped the market rally and help stabilize the economy is that the magnitude of the stimulus actually caused real disposable income, what households have to spend, to go up year over year. And of course, that's a function of the generosity of some of the initial packages. We have a fiscal cliff coming next week. If that is not replaced, or at least mostly replaced,
I'll be right back in a few seconds. Please refresh. Please press F5. Yeah, I need to restart Streamer because we receive lots of data. Okay, let's see if I will close right now during this Streamer this position. If not, I will restart and you will need to press just F5 in about a minute, okay? Appreciate it. Thank you.
We do think you're entering a period where it's going to be probably more volatile. Obviously, the fiscal side is one component. We still don't have the virus under control. You're seeing a deterioration in U.S.-China relationships. And then finally, there's the 800-pound gorilla of all the uncertainty going into the election. So, yes, I think the reality is it's going to be a more volatile, range-bound market during the next several months.
Francine, that's an 800-pound panda, in case you were asking. It's not an 800-pound gorilla.
Thank you for the translation, Tom. Yeah, Russ, what do you want in the stimulus package from the U.S.?
Well, I think the most important thing is to continue to support U.S. households. I think another important component is to support the healthcare system, which obviously is still struggling to deal with the pandemic. And the third component I think is very important is supporting the states. States are under enormous fiscal pressure. You think about the massive loss of revenue, given people working from home, all of the closure of businesses. That's the third component I think the market's going to be watching very closely.
What does it all mean for market dislocation? Where do you see the biggest market dislocation, Russ?
Well, I think that the place to watch probably more than others right now are some of these cyclical names that have just jumped and surged over the last several months. And it's been uneven, and these value growth rotations seem to go back and forth every other day. Yeah. But you have seen a massive rebound in companies and segments of the market that are directly tied to household spending. And again, that was not completely irrational if you believe the government's going to continue to prop that up. If it's less generous, If we're going to see more shutdowns, which cause a deceleration in economic activity, you've got to question whether those types of stocks can continue to rally or if they're due a pullback.
Well, what is your bet on allocation? I mean, the bond market, we'll talk to Rosenberg about that. What's he know? But Russ, in the equity market, there's three outcomes as a general statement. It's still a tech rally. We finally rotate over to the unloved, as you mentioned, the cyclicals, or the oddest of odd things, both go up or at the same time both go down. Which will it be?
I think we're still going to be in an environment where, let's call this the next 6 to 9 months, because I can't tell you what's going to happen tomorrow. Sure. But over the next 6 to 9 months, I still think that you're going to see tech outperform. And it's not just tech. It's healthcare as well. It's tech-related names within consumer discretionary. And the basic reason is these business models, this is not 99. These are phenomenal companies. They've got unprecedented cash flow generation. And Tom, as you very well know, for the cyclicals and the values to rally for more than a week or two, you're going to need a sustained recovery. And that's still something that's not obvious. We're going to have a recovery, but is it going to be consistent enough to drive the type of value rally we haven't seen since the back half of 16?
Sounds great. Russ Kostritz with us. We're going to come back. Lots to talk about there, particularly this allusion back to 1999. Later on here, right now, futures -7, Dow futures -42. The game theory of the moment. How many T decisions are out there right now? And are they interrelated? Sounds like I'm Dr. Mohammed El-Arian in the 9 o'clock hour. John Farrell will do the grilling.